minus, and we minus the 184,000. And then we have salaries and wages due at the end of the current year. At the end of the current year, that is for this year now, because it is workers offered the service this year, only that we didn't have money to pay them by the end of the year, but they rendered the service this year. So the income was generated, the one they assisted to generate was for this year. That one we add. We add 150,000. Now, because there's nowhere else we have salary being mentioned, we can get the net. So 1660, 400, and then we minus 184,000, and then now we add 150,000. So in this case we get 1626, 400, which we minus. And it's also important for me to mention that this one we normally do it this way, instead of opening the salaries and wages account or even the commission account where you try to get for commission for this year, the one that you bring here, or this, it will give you the same, but that's a long process. It's a wastage of time. Just do it this way. Then we go back to where we found the salary. After the salaries and wages, there is rates and insurance in the cash transaction. Rates and insurance, that's allowable because they are for the business. They are allowable expenses. So we'll come here, rates and insurance. Now we check if it is mentioned somewhere else, that rates and insurance. Yes. If you go to the summary of assets and liability, there is prepaid rates, that last 10. So we have to open a bracket there, and we start with the rates and insurance in that year. The one that was paid, it is for that year. We add, and we add 320,800. Now when you come to the prepaid at the beginning, you see when you are starting the year January and you have a prepayment, that must have been for the current year. You are prepaying for the current year. That we add 50,000. And when now you get to the end of the year and you have a prepayment, you are prepaying for the following year, which means whatever you paid this year, part of it was for next year. That one you minus. So we minus 72,000. Having no other place it has been mentioned, we get the net, which will be 320,800, and then we add 50,000, and then we minus 72,000. Which give us 298,800. There. We go back to where we found that rate and insurance in the cash summary. After rates and insurance, medical bill. Medical bill is allowable, but the problem this time is for self. And we said here, when you are taxing a sole proprietor, any expense relating to the owner, private expense, we don't allow. This we even said when you are looking at the general allowable and unallowable expense. And an unallowable, anything to the owner, we don't allow. Private expenses, so that is not allowable, we won't deduct. The other one is transport. Transport is allowable and it isn't mentioned anywhere else. So transport, which you have 56,400. After transport, bank charges. Bank charges are also allowable. They are for business and they are not mentioned anywhere else. Bank charges, which we have 3,000. After that, general expenses. General expenses are also allowable. There are small expenses that are put together for the business. General expenses, which you have 145,400. The next one is loan interest. Loan interest, we said interest on money borrowed and invested in business is allowable. So loan interest, allowable. Amount 120,000. After that, new motor vehicle. Fixed asset we said we don't allow. We allow capital allowance, of which case we said motor vehicle capital allowance at the rate of 25%. Capital allowance, written in short as CA, motor vehicle, 25%. But check whether you have the balance at the beginning. We take the balance at the beginning. If you go to the summary of assets and liability, at the beginning we had a motor vehicle, 960, of which case will be 960. Then add the one that was purchased in that year, which was 600,000. With nothing more, get the amount. That will be 960,000 plus 600,000, giving us 1560,000 times 25%, which give us 390,000. We go back and continue. After the new motor vehicle, drawings we said they are private expense, they are for private use, we don't allow them. Then we go to the summary of assets and liability. Furniture is a fixed asset, we claim capital allowance on it, so we'll have capital allowance on furniture and fitting, in short. So 10% of, we start the balance at the beginning 120, and there was no addition of furniture. There is nowhere we are told about addition, so we just take 10% of 120, which gives us 12,000. After that we go back. Summary of assets and liability for furniture, we have considered. Motor vehicle we had considered already, is there, capital allowance. Trade payables, that's not an income, not an expense. Inventory, not an income, not an expense. Trade receivable, not an income, not an expense. Salaries and wages we had considered. Prepaid rates we had considered. Commission received in advance we had considered because we had met them earlier. Capital, no, that's not an income or an expense. Additional information, number 1, discount allowed and discount received during the year were 50,600 and 151,200. Discount allowed is an expense and an allowable one. We'll have discount allowed, which we have 50,600. Then discount received 151,200. That is an income and a taxable one. We had said that when you were looking at the general taxable and non-taxable income. Discount received, a taxable operating income, 151,200. Then additional information number 2. During the year she took goods for free from the business worth 100,000 for her own use. That's an expense, yes, but it's not usually allowable, we said, because it's for private use. Number 3, depreciation was ascertained as follows. Remember, we said depreciation is not allowable. What we allow are the capital allowance in taxation, which we have considered. So ignore. Depreciation is not allowed. Number 4, bad debts written off during the year amounted to 72,000. Trade bad debt written off are allowable. Unless we are told they are not relating to the trade, to the business, they are allowable. Bad debt. And take note, don't confuse with provision. Provision are the one that we say specific provision we allow, general provision we don't. Bad debt are bad debt, and they are allowable as long as they are relating to the business. Bad debt written off, which we have 72,000. Bad debt is the last item provided. So what do you do now? We are done. We now have to get, we come now to the end here. We get net taxable operating income. So from operation, how much is the total taxable income? That means that we take the gross profit plus this income minus the expenses, allowable expenses. We start with 43,76,000. Then we add 68,000. And then we add 151,200. And then we minus 16,26,400. and then we minus 298,800, and then we minus 56,400, we minus 3,000, we minus 145,400, we minus 120,000, we minus that 390,000, we minus 12,000, we minus 5,600, then we minus 72,000. It gives us 18,260. So what we do is this. This being a sole proprietorship business, we had said earlier on, we tax the sole proprietor on his or her own income. So once you get the net taxable operating, add taxable investment income. So you add taxable investment income. If operating income is positive like this one, if the operating income is negative, you carry it forward to next year to be deducted against the profit of next year. Remember we said we carry forward a loss up to a maximum of 10 years. Now, if you look at the question that we have, there is nowhere we are told about investment income for now. But if you had non-qualifying dividend, remember those are dividends which withholding tax is not final. Non-qualifying interest which withholding tax is not final. Royalty income for resident withholding tax is not final. Rental income for commercial buildings, for residential above 15 million per year, we should add them here. But for this question we don't have, so we would have a dash. And so meaning we can now get total taxable income, which would be the same because the investment is 0, 18,600. And required number 1 ends there. Now we have the taxable income. What we had said, the first thing is to determine the taxable income. The second one now is to determine the tax payable. Criteria of determining the tax payable. Now we have to tax that income on that individual, and which we said that sole proprietor do not have separate legal entity from the business. So the income of the business is taxed on the owner. So how do we tax? We had said at graduated scale rates in the same way as employment income. So we want to look at how we tax that income. We are going to use the scale rate that was used in the year 2022. But the concept is the same. What happened is that if the rule changes, and the reason why we are looking at year 2022 because we are looking at the exam of December 2023, if the rule change, you find that the table just changed, but the concept of getting what you are, the computation is or remain the same. So I'm going to delete this part here so that we can see how we can tax the 18,260 to get the tax that is payable by this sole trader. So to come here, tax payable. So we want to get the tax payable. So if you look at the income that we have, it is 18,260. Now there is a table that is given by the examiner in an exam, or the question, as long as you are doing the question about tax, you will be given first page. And as we have said, we are using the table that was used in the year 2022, but it is relating to the year of income of 2021. But that's the one that we are going to use. So if you look at the top there, there's somewhere with the rates of tax, including wife employment income, self-employment income, and professional income rates of tax. Year of income 2021. Assume that the following rates of tax were applied throughout the year of 2021. We have the monthly taxable pay, annual taxable pay, rates of tax. Because we are taxing an year income, not 1 month. It was for the year ending 2015, 1 year. We use the annual taxable pay, which starts between 1 shilling to 288,000. The percentage is 10%. Between 288,001 to 388,000, 25%. Excess over 388,000, 30%. So if you look at the income that we have there, 18,20,600, that means that we go to the excess of 388. So we have to tax up to the rate of 30%. How do you start? You start with the first. Now, at the rate of 10%, pick the last amount appearing in that range. Between 1 shilling to 288, pick 288. So the last amount appearing there. So we say first 288,000 times 10%. It gives you shillings here 28,800. Then you come to the next. The next, you take between 288,001 to 388, 25%. Now we don't pick the last amount and we tax at 25 like we have done for the first one. No. You take the difference between the last amount appearing there, which is 388,000, minus the last amount appearing in the previous rate. In the previous rate, the last amount is 288,000. So 388,000 minus 288,000 give you 100,000. So to come here, 100,000 times 25%, which gives you 25,000. 25,000. After that, we go to the excess over 388,000, which we tax at the rate of 30%. Excess over 388 means what? It means that we have already taxed 388. If you take 288 plus 100, that will be 388. So whatever is above 388, you tax at the rate of 30%. How much is that? So this we call it last. The last, which is now the total taxable amount, 18,20,600. You less what you have taxed. You have taxed 388. 288 plus 100, that will be 388. So this one, you multiply by 30%. The excess now. So let us get the excess first, which would be 18,20,600 minus 388,000 gives you 14,32,600. Then times 30%, which gives you 429,780. Then, because that is the last one, you add those taxes to get something called gross tax. Gross tax, which would be the 429,780 plus 25,000 plus 28,800, which gives you 483,580. That we call it gross tax. Now, after you get the gross tax, there are 3 items you are supposed to deduct here, which are called set off. They are the same that we talked about when we were looking at the employment income, only that we don't have pay as you earn. Pay as you earn is usually for a person who is on salary. This is just a person in business is not on salary, so we ignore. But now, personal relief is one of the set-off we talked about, of which case personal relief is provided in the table. If you look at the table we have used to tax, just after the table there is personal relief per month 2,400. If you multiply by 12, you get per annum 28,800. The next one is called insurance relief, and we said this for a person who have education or life insurance cover or NHIF insurance cover, and I showed you how to compute. So if this individual had that, if this sole trader, that is a lorry trader, had the insurance life or education on NHIF, we could have claimed the insurance relief, but didn't have, she didn't have, so we ignore. The other one is withholding tax on investment income, which withholding tax is not final. That means that you have to look at the investment income you have added here. If you had added something like non-qualifying dividend, remember there is a withholding tax of 15%. You'll come and say investment income, withholding tax 15% of the gross to remove it. But we didn't have. So for now, the only set-off we have is the 28,800, and this will give us the net tax payable. The net tax payable, which will be the 483,580 you minus the 28,800, which gives us 454,780. And that answers required number 2, where we were supposed to get the tax payable by Royce Lubandi, and it ends there. For now, that is how we usually tax the sole proprietorship business. We end our lesson there until next time, when we are going to look at the taxation of the partnership. Thank you very much. Yours here, Patrick Kamau Kamure.
Hello and welcome back to the lesson. In our today's session, we're going to continue with the topic boardroom decision making. We will study evidence-based decision making. By the end of this lesson, we should be able to explain the various sources of evidence. The various sources of evidence. Now, the basic idea of the evidence practice, evidence-based practice, is that good quality decisions should be based on a combination of critical thinking and the best available evidence. You understand? The basic idea of evidence-based practice is that good quality decisions, good quality decisions should be based on combination of two things. Should be based on combination of 1, critical thinking, and 2, should be based on critical thinking and the best available evidence. The best available evidence. Not just evidence, but the best available evidence. And although all management practitioners use evidence in their decisions, many pay little attention to the quality of that evidence. The quality of that evidence. That's why I said the evidence should not just be any evidence, but it has to be the best evidence. And the result of that is that bad decisions based on unfounded beliefs, based on fads, based on ideas popularized by management gurus are made. And the bottom line is bad decisions. The bottom line is poor outcomes and limited understanding of why things go wrong. So evidence-based practice seeks to improve the way decisions are made, and it is an approach to decision making and day-to-day work practice that helps practitioners to critically evaluate the extent to which they can trust the evidence they use in making decisions. It also helps practitioners to identify, to find, and evaluate additional evidence relevant to their decisions. So evidence-based practice is about making decisions through the explicit and judicious use of the best available evidence. The judicious use of the best available evidence. And there are multiple sources of evidence. Sources of evidence. We are going to examine some of the sources of evidence. Why? Because before making an important decision, an evidence-based practitioner starts by asking, what is the available evidence? And instead of basing a decision on personal judgment alone, an evidence-based board or manager finds out what is known by looking for evidence from multiple sources. So what are the sources? What are these sources? Number one, scientific literature. Scientific literature. Now, scientific literature is comprised of findings from empirical studies published in academic journals, findings from empirical studies, findings from empirical studies published in academic journals, and this is the first source of evidence, the first source of evidence, which is scientific. We are talking about scientific literature. All right? And over the past few years, the volume of management research has escalated hugely, with topics ranging from evaluating merger success, the effects of financial incentives on performance to improve employee commitment and employee recruitment, and governance structure, corporate governance, and so on. And there is also much relevant research from outside the management discipline, since many of the typical problems that managers face, such as how to make better decisions, how to communicate more effectively, and how to deal with conflict, are similar to those experienced in wider range of contexts. We have scientific literature from psychology, all right, and other fields that are still relevant to management. And although many practitioners learn about research findings as students or on professional courses, new research is always being produced, which often changes understanding of managers. And in order to include up-to-date evidence from the scientific literature in board decisions, it is essential to know how to search for studies and to be able to judge how trustworthy and relevant they are to board decision making. All right? So that is scientific literature, which I've said that includes findings from empirical studies in academic journals. Then number two, evidence from the organization. Evidence from the organization itself. All right, whether it is a business or whether it is a hospital or a government agency, organizational evidence comes in many forms. It can be financial data such as cash flows or costs, or business measures such as return on investment, the market share, and so on. It could include the financial statements, the income statements, and it can also come from customers or from the clients in form of customer satisfaction, repeat business or product return statistics. It can also come from employees through information about retention rates or levels of job satisfaction and so on. And evidence from the organization can be hard numbers such as staff turnover rates. It can include medical errors, hard facts, hard numbers, as well as productivity levels. But it can also include soft elements such as perceptions of the organization culture or attitudes towards senior management and so on. And therefore, evidence from the organization is essential to identify problems that require managers' attention. It is also essential to determine likely causes, plausible solutions, and what is needed to implement the solutions. So evidence can also be gathered from within the organization itself. The third source, number 3, evidence from practitioners. Evidence from practitioners. Now, this is a third source of evidence. All right? It is evidence from professional experience. It is evidence from judgment of managers, consultants, business leaders, and other practitioners. And candidates, different from intuition, opinion, or belief, professional experience is accumulated over time through reflection on the outcomes of similar actions taken in similar situations. And this type of evidence is sometimes referred to as tacit knowledge. Tacit knowledge, sometimes referred to as tacit knowledge. It is sometimes referred to as tacit knowledge. And professional experience differs from intuition and personal opinion. Why? Because it reflects the specialized knowledge acquired by repeated experience and practice of specialized activities. And many practitioners take seriously the need to reflect critically on the experience and distill the practical lessons. Their knowledge can be vital for determining whether a management issue really does require attention, and if the available organizational data are trustworthy, whether research findings apply in a particular situation, or how likely a proposed solution is to work in a particular context. Evidence from practitioners. The fourth source, evidence from stakeholders. Evidence from the stakeholders. Now, this is the fourth source of evidence, which is stakeholders. Okay? Now, stakeholders are any individuals or groups who may be affected by an organization's decisions and their consequences. Internal stakeholders include the employees, the managers, the board members. stakeholders outside the organization, such as suppliers, customers, shareholders, the government, and the public at large, may also be affected. So, evidence from stakeholders is all about the stakeholder values and concerns. Stakeholder values and concerns. The stakeholders that I've mentioned have values. They have concerns. And the stakeholder values and concerns reflect what stakeholders believe to be important, which in turn affects how they tend to react to the possible consequences of the organization's decisions. So stakeholders may place more or less importance on, for example, short-term gain or long-term sustainability, employee well-being or employee output, organizational reputation or profitability, participation in decision-making or top-down control, and so on. Organizations, candidates that serve or respond to different stakeholders can reach very different decisions on the basis of the same evidence. And gathering evidence from stakeholders is not just important for ethical reasons. Why? Because understanding stakeholder values and concerns also provides a frame of reference from which to analyze evidence from other sources. It also provides important information about the way in which decisions will be received and whether the outcomes of those decisions are likely to be successful. So these are 4 sources of evidence which the board may rely on in making decisions. At the beginning, I said evidence-based decisions or decision making is all about making quality decisions, which should be based on combination of critical thinking and the best available evidence. So as a board member, as one who sits on the board, you ought to develop critical thinking skills. You need also to learn how to gather evidence from some of these sources I've mentioned, because there is always evidence or information from scientific literature, which is found in empirical studies in academic journals. You need to know how to search for the best, for the relevant data. You may also need to have skills on how to gather information from the organization, from the employees, from the clients of the company, and so on. You should also learn how to gather knowledge from practitioners, business leaders, industry leaders, the experts, the consultants, and so on. Skills are also required in gathering evidence from the stakeholders, the internal stakeholders, the employees, the managers, the board members, and so on. Or external stakeholders, the suppliers, the customers, the shareholders, the government, the members of the public, and so on. We've said evidence from stakeholders is all about the stakeholder values and concerns. Stakeholder values and concerns. We've said stakeholder values and concerns reflect what stakeholders believe to be important, which in turn affects how they tend to react to possible consequences of the decisions that could be made by the board. So that will bring this lesson to an end. Evidence-based decision making. Here is your assignment. Examine 4 sources of evidence needed for decision making by the board. Examine 4 sources of the evidence needed for decision making by the board. When answering the question, don't rely on your notes. Try and see if you can recall what we have learned in our today's lesson. Thank you. God bless you. In our next session, we will continue and we're going to study the cognitive bias. That is subtopic number 3, cognitive bias. Bye-bye.
Hello learners, welcome to Manifested Publishers e-learning portal. In our today's session, we are looking at costs of production or theory of costs. So theory of costs can be looked into 2 perspectives. We normally have the long run and the short run. So I'll begin with the short run analysis of costs. Short run So short-run analysis can be looked into 2 perspectives. We have the long run and the short run. So I'll begin with the short-run analysis of costs. In the short run is where at least one factor input must be fixed. Fixed means when the market conditions change, that factor will not change. So like, for example, when we are changing the level of output from one level to another, a fixed factor will not change. It will remain the same regardless of the level of output that you are changing. And a good example is something like rent. Like when you have rented a premise and then you are using that premise for your business purposes, the time you are not using that premise, whether you use it or not, you will still have to pay rent. So meaning at 0 level of output, fixed cost or fixed input factors will still be incurred. And then the time you use, it does not matter the level of usage. The more you use, still that input factor will remain the same. So we can define it. What is a fixed input factor? What is a fixed input factor? This is a factor which does not change or vary, or vary with the level of output. So it remains the same. Graphically, if we are to present a fixed factor, this is how it will look like. So this is a fixed cost. So this is the level of output, which is in units. And here we are talking of costs. So we begin from 0 output. So when you are producing 0 output, a fixed cost will still be incurred at this point. Even if I increase my output to 1, to 2, to 3, and so on, that cost is remaining constant at all levels. And that's what we refer to as a fixed factor or a fixed input factor. Then number 2, we have variable input factor, which is also a variable cost. So a variable input factor is that which varies, with the level of output. So that simply means when we are changing the level of output, that factor will change in the same proportion. The time we increase, it will also increase, and the time we decrease, it will also reduce. So to illustrate this graphically, this is how it will look like. We have output, which is in units, and then we have costs. So a variable factor will look like this. This is total variable. So we are beginning with the 0 output. So at the time I produce 1 unit, the cost will not be the same. It is rising. The time I increase my production, the cost is also increasing, and so on. So if this is 1, this is 2, 3, and so on, the time you increase, it will also increase, and that's how it continues. We also have what we refer to as total cost. Total cost. This is the sum. This is the sum of fixed and variable costs. So how do we illustrate this? This is how we represent a variable, a total cost. So we have 0. This is output level, which is in units. And then we have cost. So the costs here are fixed costs, total variable cost, and total cost. So we have a relationship between this cost. We are saying that total cost is simply the sum of the fixed cost and the variable cost. So these fixed costs are those that are remaining constant, and then the variable are those which are changing in direct proportion with the level of output. So when we take fixed costs plus variable cost, it will give us a sum which we are referring to as total cost. So how do we derive these curves? We have a relationship between total cost curves, total variable cost curves, and fixed cost curves. So what is the relationship? The total cost curve is drawn based on the law of diminishing returns. So what happens is, like when total variable costs are rising, initially we do not have any cost that is incurred. The only cost that is being incurred here is a fixed cost, which is remaining constant. So when we have 0 output, where we have 0 output, so that means no output is produced, fixed cost equals total cost. Where there is 0 output, fixed cost equals total cost. But the time variable cost begin to rise as the level of output changes, then total cost will begin to rise. So at the time variable costs are continuing to rise, the total cost will continue rising. And therefore, total cost curve can be explained by diminishing or increasing returns to the variable factor. And this variable factor is that which is bringing about the level of change. So it normally increases or it decreases depending on the factor, variable factor. That means when the variable factor is decreasing, total cost will decrease. But when the variable factor is increasing, total cost will always increase. So that when we take fixed cost plus variable cost, we'll be able to get what we are referring to as total cost. We have other costs again which are associated with the short run, and we have what we refer to as average fixed cost. Average fixed cost. Average fixed cost. So what is average fixed cost? Average fixed cost is simply the fixed cost per unit. fixed cost per unit is the fixed cost per unit of output. And so that simply means to calculate or to get average fixed cost, which can be abbreviated as average fixed cost, we simply take the total fixed cost and then we divide by output, which is indicated by Q. So we say where Q is simply referring to output in units. And graphically, how do we represent this? This is how it will look like. So we have output in units. Then we have costs. We have an average fixed cost. This is the average fixed what? Fixed cost. So we say this curve is continuously falling, but even as it falls, it is not able to touch or to reach both axes. So we say it is asymptotic. Asymptotic simply means though it is falling and it seems to be reaching the x-axis, it can never reach the x-axis. That is the average fixed cost. We also have another one known as, this was our number 1, number 2. This is number 3. I can call this number 4. So I can use this space. So we move on to number 5. So our number 5 cost is average variable cost. Average variable cost. This is the variable cost per unit. So mathematically, we say that average variable cost equals total variable cost divided by output in units. So we say that where Q is referring to output, which is in units. Graphically, it will be as follows. So this is output in units, and these are costs. So this will be our variable, average variable cost. The cost curve is U-shaped. So we'll explain why it is U-shaped. It is U-shaped simply because of the diminishing returns to the variable factor. And then we move on to the other cost, which is average total cost. Average total cost. This is our number 6. Average total cost, which is simply the total cost per unit. Or is average fixed cost plus average variable cost. So it is equal to this total cost. Average fixed cost plus average variable cost will give us this. I can use the same format. Total cost equals average fixed cost plus average variable cost. So how do we illustrate this using a diagram? It has the same shape with that of average variable cost, and it is also U-shaped. So this is the average total cost, which is also the same as average cost. So here we have output in units, and then we have costs. Our next cost will be marginal cost. Marginal cost. So a marginal cost is that cost is an additional cost that arises, or it is a cost that is increasing the total cost just because of an extra unit that is produced. So the additional cost that is incurred for producing an extra unit. The additional cost that is incurred for producing an extra unit. So in simple words, what is a marginal cost? Like, for example, you may have been producing at, let's say you are producing 10,000 units, and now you are increasing your production to 15,000 units. A marginal cost is that cost which will be incurred for you producing an extra unit. So in this case, our extra units will be 5 units. You want to produce 5,000 units more than what you've been producing. So the costs that are associated with the 5,000 units that you are producing is what we are referring to as a marginal cost. So a marginal cost cannot be incurred where there is no change of output. It only arises when we have changed, and that change is an increase because it is the cost of an additional or producing an extra unit. So how do we illustrate the relationship? So a marginal cost is also U-shaped, just like a average total cost and average variable cost. We can now illustrate the relationship that is existing between the average cost, and this is how it will be like. Relationship between average fixed cost, average variable cost, and marginal cost. And just to add on marginal cost is simply change. It is change in total cost over change in Q. Change in total cost divided by change in Q. That will give you the marginal cost. So change for the table form questions is referring to the difference between the highest and the lowest, or the new and the initial. And if we've been given a function, then change will refer to differentiating that particular function. So what is the relationship between average fixed cost, average variable cost, and marginal cost? I'll explain that using a diagram. So we have output, which is in units, and then we have costs. So we have the average fixed cost, we have the average variable cost, then we have the marginal cost, and then we have the average total cost. Average total cost. So what is the relationship between average fixed cost, average variable cost, average total cost, and marginal cost? So marginal cost is intersecting with the average variable cost at its lowest point. That is at when it is at its minimum is when we have intersection of the marginal cost and the average variable cost. And then when marginal cost is below the average variable cost, the average variable cost must be decreasing, not increasing. When the marginal cost is below average variable cost, then the average variable cost must be decreasing. And then at the intersection of the average variable cost, at the intersection of marginal cost with the average variable cost, then the average total cost must be at its minimum. At the intersection of marginal cost and the average variable cost, the average total cost must be at its minimum. And then once we have that intersection, when the MC is above the average variable cost, the average total cost is increasing. The average variable cost is also increasing. And then average fixed cost is falling continuously. So as others are rising, this is falling continuously, though it is not able to reach at the x-axis. So we say it is asymptotic, meaning it cannot touch or intersect with the x-axis, neither can it intersect with the y-axis. So this is the relationship between these curves. And that brings us to the end of short-run analysis. So just to give a summary, in short-run analysis, it's a period where at least one factor must be fixed and the other one must be varied. So what are the costs associated with the short run? We have the fixed cost, the variable cost, the total cost. Be able to explain, be able to back up your explanation with the graphs required. And then we also have average cost. So we mentioned average fixed cost, average variable cost. We have average cost or average total cost, as well as marginal cost. Be able to explain, and what are the graphs. If they are required in your exams, you should be able to explain, backing up your explanation with the graphs, and then show the relationship that is existing between graphs, both for the costs and the average costs. And that's all about short run analysis. Bye bye. Let's meet in the next session. Hello learners, welcome today to our today's session. We are doing a mathematical approach to the theory of costs. Mathematical approach to the theory of costs. So we normally have two different types of questions set on this question. And one is, you may be given a table, and in that table you already have figures, like on the level of output, you are given the fixed cost, you are given the variable cost, and then you can be told to use that to calculate the total cost, the marginal cost, the average fixed cost, average variable cost, and the average total cost. So in case you are given such a question, then how do you go about answering that question? So I'll give an illustration. We are assuming a case where you've already been given the level of output, you know the fixed cost, and you know the variable cost. How can you use this to derive all other costs of a particular firm? So I'll give a table we have output. So this output is in units. Then we have fixed cost. We have variable costs. Then we will use this information to calculate the total cost. Then we'll calculate the marginal cost, then average fixed cost, average fixed cost. Then we'll calculate average variable cost, average variable cost. Then we'll calculate the average total cost. Average total cost. So in this case, you've already been given the output. So we said that fixed costs will remain constant all through. So fixed costs are not changing. Output is increasing by 1 unit. And then these are the variable costs that we've been given. So how do we calculate the total cost? So to calculate the total cost, we said that total cost equals fixed costs plus variable costs. So we are simply taking the fixed cost plus the variable cost to calculate the total cost. So for this, at 0 output, we are taking 50 plus 0, which will give us a total cost of 50. Then for the next 1 unit, we have fixed cost 50 plus 20, which will give us 70. Then next we have 50 plus 30, which will give us 80. 50 plus 35 will get 85. 50 plus 45 will get 90, 95. Then 50 plus 65 will get 115, and this will give us 160. That's how we calculate the total cost. Then next we calculate the marginal cost. We say this change in total cost over change in Q, which is the same as change in TC over change in Q. So whenever we've been given such like a table, the formula that we'll use in this case is this change. And where we've been given a function, then this is what we will use. So for this case, we are using this change in total cost over change in Q. So this is simply the same as we are taking Y2 minus, Y is referring to total cost, Y2 minus Y1 over X1, X2 minus X1. So what is our Y2? What is our Y1? At 0 output, there was no variable cost that was incurred, so that our total cost is 50. So the marginal cost is the change where when when you are not producing, no variable cost will be incurred. And when we are beginning to produce at unit 1, the variable cost is now 20, and it has increased the total cost from 50 to 70. So what is the change? It is simply that 70 minus 50. So at our 0 level, there is no marginal cost that is incurred. But when we are beginning to produce 1 unit that is bringing a change because of a change in the variable cost, then the output is increased to 70. So to calculate the marginal cost, we are, for the first unit, we are taking 70 minus 50 divided by 1 minus 0. So our Y2 is this new cost, which is the new total cost, and our Y1 is the initial cost, which in that case is 50. So 70 minus 20 divided by 1 minus 0, which is just like 1, will get what? Will get 20. And that's our marginal cost. Then in the next, we have again increased the output by 1. So what will be the marginal cost? It is now 80 minus 70 divided by 2 minus 1. So because we are increasing the level of output by 1, that means we will simply be dividing by 1. So it is the same as 80 minus 70 over 2 minus 1, which is just the same as 30 divided by 10 divided by 1. So the marginal cost for the second unit will be 10. And then 85 minus 80 divided by 3 minus 1 will give us 5. Then next we have 95 minus 85, which will give us 10 divided by 4 minus 3, which is 1. So the answer is just 10. And then we move on to 115 minus 95. This will give us 20. And then we are taking 20 divided by 4 minus 5, which is just 1. Then marginal cost for the last unit is 160 minus 115, which will give us 45. That's how we calculate the marginal cost, change in total cost over change in output. Then how do we calculate average cost? We say that average fixed cost equals fixed cost over output. So for the first unit where we have 0 input, our fixed cost was 50. So when you take 50 divided by 0, the average cost here will be 0. And then for the next output, our fixed cost is 50 divided by 1, which will give us 50. For the second output is 50 divided by 2, which will be 25. 50 divided by 3, that's for the third output, it will give us 16.67. And then for the fourth is 50 divided by 4, which will give us 12.5. Then 50 divided by 5 will give us 10. And then 50 divided by 6 will equal 8. Then we'll have calculated the average fixed cost. We do the same for average variable cost. We say that average variable cost equals total variable cost, or which is just the same as variable cost over Q. So our variable cost for output unit 0 was 0. So this will give us 0. Then for the first unit, the variable cost is 20. To calculate the average, we are taking 20 divided by 1, which will give us 20. For the second unit is 30 divided by 2, which equals 15. For the third unit, we have 35 divided by 3. And this is equal to 11.67. For the fourth unit, the variable cost is 45. So 45 divided by 4 will get 11.25. For the fifth unit, we have 65 divided by 5, which equals 13. And for the last unit, the variable cost is 110 divided by 6, which will give us 18.33. Then lastly, how do we calculate average total cost? So we say that average cost or average total cost equals average fixed cost plus average variable cost. So since we've already calculated the average fixed cost and the average variable cost, we simply sum these together. So we'll have 0 plus 0, which will give us a 0. 50 plus 20 will give us 70. 25 plus 15, this is 40. Then 16.67 plus 11.67 equals 28.34. Then 12.5 plus 11.25 equals 23.75. And 10 plus 13, this is 23. Then we have 18.33 plus 8, which is 26.33. So that's how we answer such a question. We have another type of question where you are given functions. So where you have been given a function, then you need to know which function is this before you can go up to solve such a question. And again, the knowledge of differentiation is very important. You need to know how to differentiate a function, because we said to calculate marginal cost, we find change in TC or in total cost divided by change in Q. So this means that function has to be differentiated, or the total cost function will be differentiated for you to get the marginal cost function. So before I do this, I'll help you to just remind you what differentiation is, or just to give a short illustration of how we differentiate functions. Like assuming you've been given a function like y equals 2x cubed plus 10x squared plus 15x plus 110, and then you are told to differentiate that function. Differentiating simply means finding the derivative of that function, or what we refer to as finding the dy over dx of the function. So to differentiate this function, what we do is we take the power, this is the power 3, you take the power, multiply by the constant. So this will be 3 multiplied by 2, which will give us 6. So we have 6x. Then we reduce this power by 1. Reducing this power by 1 means it will be 3 minus 1. And that will give us 2. So the power will be reduced by 1 so that we have x squared. Then plus, we take the power, which is 2, multiply it by the constant. The 2 times 10 will give us 20x. They reduce this power by 1. So reducing the power by 1 means we'll have 2 minus 1, which will give us x raised to power 1. So mathematically, we don't write x raised to power 1. We just write x. So it will be 20x. And then next we are plus. This x is the same as x raised to power 1. So I say that in mathematics, we are not saying that it is x raised to power 1. We are just writing x, but it is x raised to power 1. So to differentiate, we are taking this 1, we multiply by the constant, which will give us 15. And so we reduce this power by 1. When you take 1 minus 1, we'll get a 0. And that means we'll have x raised to power 0. So x raised to power 0 is just like that constant having no unknown. So we write 15. You don't write x raised to power 0. And then plus x 110. 110 is a constant, and this simply means it has an unknown that is raised to a 0. So when we have an unknown which is x that is raised to power 0, in differentiation we are taking the power which is 0, then multiply that 0 by the constant. The answer will just be 0. So whenever you've been given whenever you've been given a constant, just put a 0, because it means it has an unknown that is raised to power 0. So whenever we differentiate a constant, the answer is always 0. So our function will now be 6x squared plus 20x plus 15 plus 0. So we now say that this will be 6x squared plus 20x plus 15, so that we leave out a 0. And that's how we differentiate. So there are some times when we may be given quadratic functions or cubic functions, which may represent the total cost. So in such a case, you may be asked to identify or to determine the fixed cost function, determine the variable cost function, and use that again to calculate the average fixed function as well as average variable cost. So how do we go about that? So I'll use a simple quadratic equation. We are assuming that we've been given a total cost function, which is a cubic function of the form a plus bq plus cq squared plus dq cubed. So a cubic function is simply that function whose highest power is 3. And so in this case, when you are told to identify or determine the fixed cost, what are the fixed cost, or what is the fixed cost function? Fixed cost is simply referring to the constant part of that function, and in this case, it is just equal to a. So when you are told to determine the fixed cost, sometimes, or maybe the fixed cost function, it will simply be fixed cost equals to a. Why a? Because a is a constant. Then what will be the variable function? Variable cost function, this will be equal to bq plus cq squared plus dq cubed. Why so? We say that a variable cost is that cost which will change or which will vary when the level of output is varied. So any constant that has a known means that when that unknown is changed, it will change. And therefore, our known here is q, and therefore the variable cost function is simply beginning from bq plus cq squared plus dq cubed. And then sometimes you can also be told to calculate now the average total cost. How do we, before I come to average total cost, we'll be told to calculate the average fixed cost. How do we calculate the average fixed cost? So we say that our fixed cost equals A. And we say that to calculate average fixed cost, it will be equal to fixed cost divided by Q. So that means if our fixed cost equals to A, then our average fixed cost will simply be equal to A divided by Q. And this will be our average fixed cost. Then sometimes you may also be told to calculate the average variable cost. Average variable cost. So we say that average variable cost equals variable cost over Q, where variable cost is simply referring to the total variable cost. So we are still using this function. We've said that our variable cost equals, so if our VC equals BQ plus CQ squared plus dq cubed. And then we are told to calculate the average variable cost. Then to get A, V, C, we will simply be dividing everything by Q. So it will be the same as BQ plus CQ squared plus DQ cubed divided by Q. So divide by Q simply means BQ over Q plus CQ squared over Q plus DQ cubed divided by Q. And what will be the result? We'll have B plus. So this is cancelling. We'll have plus CQ plus DQ squared. When we are dividing mathematically, we do what? We subtract the powers. So we have BQ divided by Q. Then this will be 1 by 2 minus 1, 3 minus 1. So the resultant figure will be, average variable cost will be B plus CQ plus DQ squared. Then if we have been told to calculate the average total cost, how do we calculate average total cost? We say that it equals average total cost equals total cost divided by Q. So we were given the total cost function, which is this. So if that is our total cost function, if TC equals A plus B Q plus CQ squared plus DQ cubed, then to get average total cost, we are simply average total cost, we are dividing the whole of this by Q, which is the same as A over Q plus BQ over Q plus CQ squared over Q plus DQ cubed over Q. So what will be ATC equal to? It will be equal to A over Q plus B plus CQ plus DQ squared. And that will be our average total cost. There are again some instances where you will now be told to calculate the marginal cost. So if you've been given the total cost function and you are told to determine the marginal cost function, what we do is you simply differentiate the total cost function. So differentiating the total cost function will give you the marginal cost function. So we say that marginal cost will be change in TC over change in Q. So if our total cost function is, if our TC equals A plus BQ plus CQ squared plus DQ cubed, then to find MC, we are simply finding the dy over dx of the total cost function. And what will it be? I say that whenever we have a constant, that constant will automatically disappear. So A will not be there. Then Q is the same as Q raised to power 1. So we take 1 times B. So we'll have B. We reduce we reduce 1 by 1. And then Q will disappear. So we have B plus, then CQ. We are taking the power, we multiply by the constant. So we'll have 2 multiplied by C, which will give us 2C. And then we reduce the power by 1, which will now be 2CQ. It will not be Q squared. We've reduced the power by 1. Plus, we have 3 times the constant. So our constant here is D. So we'll have 3 multiplied by D, which will give us 3D. We reduce this power by 1. which will now be q raised to power 2. And therefore, our marginal cost function will now be b plus 2cq plus 3dq squared. And that will be our marginal cost function. So we can take an illustration, a mathematical illustration. Can wrap this part. So as we come to the end of this session, I want to give you an assignment. And this is the assignment. You are told that the total cost and demand functions of a firm under monopolistic competition are represented as follows. So total cost equals 850 minus 8q plus 10q squared. P equals 200, where total cost equals, TC equals total costs, Q equals output, and P equals price. Then required part one of the question, fixed cost function. Roman 2, variable cost function. Part 1, we have fixed cost function. Then Roman 2, variable cost function. Roman 3, average cost function. And then Roman 4, marginal cost function. So you try the question using the principles I've given, and then you'll be able to get all that you are required to get. So bye-bye. Let's meet in the next session. Hello learners, welcome today to session 3 or lesson 3, where we want to look at long-run analysis of costs. Long-run analysis of costs. Long-run analysis of costs. So in the short run, we said that this is normally a period where at least one factor must be fixed and the other should be variable. In the long run is where all factors can be varied, and therefore we do not have any like law of diminishing returns to variable factor, because we are assuming that all factors can be varied. Varied meaning we can interchangeably vary the proportions of different factors. Why? Because they will not remain constant, as in the case of short-run analysis. So what operates in the long run is the economies or these economies of scale. So when the farm factors can be varied, the farm can either experience economies of scale or these economies of scale. So in this lesson, we want to look at economies of scale in relation to internal economies of scale. So what are economies of scale? Economies of scale are simply those advantages that a farm enjoys after it has expanded. We normally have what we refer to as an optimal size of a farm. And an optimal size of a farm is simply that efficient size that a farm can have so that it's able to produce at the minimum or the lowest production cost per unit, so that it has no option of either increasing or decreasing its level of output. So in that case, we say that the farm is operating at its optimal size. And that's when economies of scale will come in. So in economies of scale, we want to begin with internal economies of scale. So what are internal economies of scale? These are those benefits, or I refer to them as advantages, that a farm can experience that are coming from within. They have nothing to do with the outside. What are the happenings that are happening in the organization, like when the farm has expanded, that can be a benefit to the farm? That's what we refer to as internal economies of scale. So they are as follows. We have what we refer to as technical economies of scale. So technical economies of scale, like when a farm increases in its size, it is normally able to use sophisticated or modern technology. And when it is using modern technology, it will be able to increase its level of output than that farm that has not expanded. And under technical economies of scale, we have such benefits like what we refer to as indivisibilities. So what are indivisibilities? Indivisibility is simply where a farm is able to take advantage of a process that cannot be reproduced on small scale. So one of the technical economies that a farm will enjoy is what we refer to as indivisibilities. And indivisibility is simply where a farm is able to take advantage of a particular process that cannot be reproduced on small scale. So that simply means this farm will have a process or a particular process which a small farm cannot have. Like, for example, when a farm has a particular machine that can enable it to produce, and when it is producing to in large scale or in large quantities, which a small farm cannot be able to produce. Why? Because a small farm produces on small scale. We say it is enjoying a benefit of indivisibility. We have another one which we refer to as increased dimension. Increased dimension is where a farm can increase its equipment, can increase the capacity of its equipment so that it is able to produce a larger output without increasing costs. That is without increasing production costs. So increased dimension is where when a farm has a particular equipment, it can decide to enlarge or to increase the capacity of that equipment so that it's able to produce a larger output than what it has been producing before without necessarily increasing the production cost. I can give an example like for these commercial services, you've been having or owning a matatu. A matatu has one driver, and then because your business has enlarged, you now decide to bring in a bus. So a bus still will need one driver, but the capacity is more large than that of a matatu. So in that case, that benefit is called increased what? Dimension. You are producing more, but you are not necessarily increasing the production cost. And if it is there, then it is very minimal. And then number 3, Roman 3, still part of technical economies of scale, we have another benefit of linked processes. So linked processes is simply where a farm can link up its processes that can enable it minimize its costs. So linked processes is where, like, we have farms that buy raw materials, and once they buy those raw materials, they use the raw materials in the production of goods and services. And then once they have produced goods and services, they again market for those goods and services before they are sold. So linked processes is simply where a farm can decide to supply for itself raw materials as well as produce the goods. It can even go up and do the marketing by itself so that it is reducing costs such as fuel cost. You don't need to get raw materials from another supplier, bring them before you produce. You simply have a portion where you are supplying raw materials. So instead of buying them from outside, you simply use what you already have, and then you will be able to do what? To produce using minimal costs. Why minimal costs? Because we will cut costs to do with transportation, etc. Those are called linked processes. And then we also have another one still on technical economies called specialization. So specialization can be where a farm can specialize, like in terms of machinery and labor, so that it produces what's quality, so that it produces what is quality. So specialization is where a farm can simply decide to specialize on a particular machine. So it buys a special machine that will enable you to produce what is quality, or have a specific class of workers who are able to help in production of that which is quality. So like when we talk of competition, what happens? Because they will be producing what is quality, their products will be more competitive than of those other farms. And then we can also talk about research, still under technical economies. Research is like when a farm has grown, it has an ability of conducting a market research. Like whenever it wants to introduce a new good or a new product, it can be able to know what are the needs, what are the tastes and preferences of the people before it can design and produce what is to satisfy the need of its customers, which may not be so with small farms. So research is where a farm will be in position to conduct a market research, which can enable it to produce that which satisfies its customers. And when that happens, that means profitability of the farm will increase. When customers are satisfied with what you produce, they will buy more, and when the more they buy, the more you'll do what? The more you will make profit. That was number one. Then number two, we have what we refer to as financial economies. So financial economies is where when the farm grows or enlarges, it normally has more in terms of assets. And for example, whenever it wants to raise like a loan or funds from a financial institution, it is in proper position to provide security or what we refer to as collateral. And because of that, they will always raise funds at a lower rate, like in terms of interest, than those that are small farms. So financial economies is where a farm is able to raise funds from financial institutions at a lower cost. Why? Because at a lower cost, because it is in position to raise assets that can be used as collateral. That can be used as collateral. Then number three, we have marketing economies. Marketing economies. So marketing economies is where when a farm expands, it will be able to like take advantage in buying in bulk. When a farm buys in bulk, it will enjoy quantity discounts. And when it enjoys quantity discounts, it means that it will be buying at a lower cost than what others will be buying at. And therefore, it will be always saving in terms of purchase. And then it can also enjoy economies to do with packaging. When it is packaging in large quantities, it is more cheaper than when packaging in small quantities. And then when it comes to selling and even distribution, it will have that advantage. So marketing economies, these are normally in the form of like buying in bulk. This enables the farm to take advantage of quantity discounts. Hence buying at a lower price, which makes them to save in terms of the purchase price. We also have packaging. Packaging is where I can just say packaging in large quantities. Packaging in large quantities enables a farm to save rather than packing in small. Why? Because when we pack in large quantities, the cost is normally spread on those units that are packaged in that one package. But when we are packaging in small quantities, then that simply means that you will incur a higher cost than a farm that is packaging in large quantities. And then number 4, we have diversification. Diversification is where when a farm enlarges, it has an ability of even producing more products. Like it can introduce new products. Why? Because it has an ability to do that. So like for example, where there is competition or when it is facing competition with other farms, it can decide to introduce new new products which can enable it to fight that competition, and that enables it to continue remaining on the market. So diversification is simply where a farm is in position to introduce new products. A farm is in position to introduce new products that can lead to increased profits, as well as acting as a risk management strategy. And then number 5, we have risk-bearing economies. So what are risk-bearing economies? Like when a farm expands, it can be able to predict risks better than small farms. Why? Because like when it is conducting a market research, it will be able to know what are the advantages, what are the disadvantages of its product, who are the competitors, and because of that, it can simply be able to use SWOT analysis so that it is able to do what? To minimize its risks than a small farm. So risk-bearing economies, we say that a large farm is able to predict risks than a small farm. Why? It has an ability to conduct a market research. It can conduct a SWOT analysis than a small farm. So those are the internal economies of scale. And then we have disadvantages or these internal diseconomies. Can look at that shortly. Internal diseconomies of scale. So in our next lesson, we'll be looking at internal diseconomies of scale. So learners, have a good day. This ends or marks the end of our session.
Hello student, my name is Isaac Jogona and welcome once again to Manifested Publishers. And last time we did a lesson on loan amortization, and I also gave you a question or rather an assignment. I want us to look on it. So in this case, let's once again open our Excel. Click start, or rather we just write Excel on the start button. we write Excel. We open our Excel that way. So in that case, let's first do a recap of what we ran. So I open where we saved the last lesson. So I just click File, Open. We saved it. We can click here, Browse. We saved it on desktop. So we check the desktop here. Check the desktop. Our folder was called Data Analytics. That is, then loan amortization. Let's open. So this is what we covered last unit, which our question was: an investor borrowed a 6-year loan amounting to 1.8 million at annual rate of 12%. We are required to prepare a loan amortization, and in that case, this is what we did. We captured what we are given, that is the interest. We are given the number of years, the amount borrowed. So what we did, we used this formula, that is a present value interest annuity factor, so that we are able to find the installment. So that's what we did last week, and from the schedule here you can see we borrowed 1.8, and by the end of 6 years we are able to complete our debt of 8.8. So that's why now by the end of the year we had 0. So what we said very important is this formula, that is the formula used, which is equals into bracket 1 minus into bracket 1 plus r less power n, all that divided by r. So from our question that we gave you last time is that an investor borrowed a 9-year loan amounting 3.6 million at annual rate of 13%. So you are required to prepare a monthly loan amortization schedule. And like this one that we did, so this is now monthly. So we have a 9-year. So 9 years, how many months? So meaning that this person is paying installment on monthly basis. So what you are going to do, this lesson that we did, let's say we are going to rename it. We rename, let's just we call it loan amortization. Let's say we call it that is loan amortization. Then we open a new sheet, so we click plus. So in that case, what you're going to do, let's just copy our question. So right click, copy. So I paste it in this other sheet. I just paste it somewhere here. Just paste it. So now we have our question. Our question here it is, and that is our assignment, that an investor borrowed a 9-year loan amounting 3.6 million at annual rate of 13%. You are required to prepare a loan amortization schedule. So just as we did with the other one, we're going to do the same. For that, let's now this one sheet, we right click, rename. We call it assignment. We call it that is a assignment. Then in that case we prepare our schedule here. Just do it here at somewhere center. Let me increase the size a little bit so that it is visible. Here we have the interest again. Going to have the interest. After the interest, also you have number of years, number of, now it is month, not years. number of months. Then after that, we have increase the size a little bit. Number of months. Then let's size it a little bit here. So after number of months, now we have the amount borrowed. Amount borrowed is amount borrowed. The amount borrowed. Then after that, we have the, also you're going to have a formula here, that is a present value interest factor of annuity. Then also you're going to have the installment. So you're going to have now the installment. So here the other one you had it here. So here this is now months, and we have after months we have the month. We have the balance brought down. Balance brought down. Still after balance brought down, we have the interest. In this case, that is the interest amount. I have the interest. Then after the interest, we have the installment. Alright, installment. Can just double click here so that it fits. Then after installment, we have the balance carried down. The balance carried down. So in that case, the interest rate you are given is 13%. The interest rate you are given is 13%. We write it there, 13%. Then number of months. So in this case, we have the number of months. We just write equals. We have said prepare a monthly loan amortization. So it is a 9-year. So it is 9 times 12. You have 12 months. So the number of months is 108 months. The period is 108. So the amount we borrowed is 3,600,000. 3,600,000. Then now that's our question. That's what we have. So in this case, the month it's 1, 2. So in this case, instead of writing 3 all the way to 108, you just need to write the first two. Write the first two. You highlight those 1 and 2. Then you autofill all the way to 108. You autofill all the way to 108. Autofill all the way to 108. There it is, all the way to 108. Now here we have 108. So in that case, so that you are able to see it well, let me just highlight it. Then we put the borders. We say the border, we can go to alignment, border. We took a thick one, click outline and inside. So that is our table, the way it looks like. So now the months here is 108. What about rate? This rate is annual rate of 13%. Still, this rate we need to convert it on monthly basis. So we are not going to use 13% there. So we are going to say it is equals 13%, that is 13%, you divide by 12. 13% you divide by 12. So in this case it's showing it's been loaded. So here we can use at least a decimal place of 2, or rather let's use 3. So our interest rate, that is it, 1.083%. That is our interest rate. So I repeat, I've said that it is equals, just as you can look here on the formula bar, it is equals 13% you divide by 2. At least I have rounded it to 3 decimal places, since when you don't round it will remain to be 1, which will have some marginal errors. So after that, the formula remain the same, which in this case we are using the present value interest annuity factor. So so in this case we come and write equals, open the bracket, which is 1 minus into bracket 1 plus R. So you click the interest rate, which is 1.083, close the bracket, raised power negative n. N is a number of months, which is 108, and then all that you close the bracket, you divide by R. So that is it, you divide by R. Then that is the present value interest factor of annuity. So then installment to be equals the amount borrowed divide by present value interest factor of annuity, then enter. So that is 56,712.916. So from there, the balance brought down to be equals what we borrowed, which is 3.6 million. Then the interest to be equals our interest rate, here it is, times the amount brought forward for the first year. Then also we say that we lock, so we click this, we lock the interest rate part, shift 4 in between G, enter, and then the installment is the installment, you click that one, enter, which is 512.916. So also we make it a constant, we lock it, make it a constant, we lock it, enter. Then what will be the balance carried down? The balance carried down, it will be equals the balance brought down for the first year plus the interest minus what you paid, enter. So that is 358.2287.08. Then the balance carried brought down for the second year to be equals the balance carried down for the first year. Then the interest, it is equals the interest equals, our interest is this 1.083, that one times the amount brought down for the second year, enter. Once again we lock, lock shift 4 and also shift 4 in between G, enter. Then from there the installment remain the same, so you click there, enter. So also we lock our installment. Also we lock our installment in that manner, enter. Then the balance carried down for the second year, the balance carried down for the second year equals, and this one minus, or rather that one plus interest amount for the second year minus the installment for the second year, enter. So from the first example we say that you have to do the first, so this is for the second month, not for the first year, sorry. It is now we are talking of month, not year. You have done the first month and you have done the second month. So having done that, you come and highlight this row of second one, then you autofill. So you have to do the first one and the second one. You have to do the first one and second one. Make sure that you have locked the interest rate so that this 1.083 remain constant. Also the installment part, also make sure that it is locked, and you lock by putting the dollar sign just as we have done. So after that you highlight the second row like that, you autofill all the way to 108, all the way to 108. Then after that we said when it appears this way, just highlight the whole of it once again, highlight the whole of it once again so that the number do not overflow. Highlight, then you format it to number. You can click here, you can see here Little General, you can click there, you just go to number direct, just go to the number direct. So now you can see here, or rather if you don't want to do that, shortcut, you can click number, then number, then OK. So by the end of 108th month, we have completed our loan, which was a 9-year loan paid on monthly basis, and the rate is 13%. I hope now you are very comfortable and you have understood the loan amortization. You have understood the loan amortization, whether it is monthly, whether it is monthly or whether it is yearly. Also you can break it down into weekly. You can also break down into weekly. You see, if you are paying on a weekly basis, how will you be able to do it? So in this case, I'm going to give you another assignment. And in this case, you're going to say that once again, and or let's say it's just a student borrowed. A student borrowed say borrowed 1 year loan amounting to 120,000 at an annual rate of 14%, annual rate of 14%, So that is a student borrowed a 1 year loan amounting to 120,000, the annual rate of 14%. So you are required prepare weekly loan amortization schedule. Prepare a weekly loan amortization schedule for the student. So in this case, that is our assignment. That is our assignment. Here it is. So that is a student borrowed a 1 year loan amounting to 120,000, the annual rate of 14%. So you are required to prepare a loan amortization schedule, to prepare a weekly loan amortization schedule for the student. So kindly do that assignment. I hope you are very comfortable with loan amortization. Next time you're going still to learn various things under still the topic of financial management. Thank you very much. God bless you and have a nice time.
Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. And maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign. Then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76. And if that is the end, you close the bracket, shift and the sign of closing the bracket on the keyboard. After that, you enter, and it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product in our previous class, I believe we might have included wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10, you can see it's highlighted, comma, C10, comma, but that is a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There's average here, but this one will pick everything. You can see up to the next place where there's nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to Tony, and it will give you everything that you want. If you enter, of course, the average is 66.60. You can undo, and again, in the formulas, you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. It means you can deduct, or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to Tony, and your average is set. So the average is set. Once you have done the correct thing, you click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course, the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case, you can see it's 70 is the highest value here. In this case, the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use min. So we are going to use min to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It's 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest. If you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mode. Most occurring. So let us see, how do you get the most occurring in mode? So you can see mode, the functions available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mode, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign, then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere, These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which we'll use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return, and this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. Given to us over here. And this solution over here, I can just drag this one down over here. This is A. And this gives us year. So we have the years given to us. They're from year 0, 1, 2, 2, and of course you know what happens once you put it like this, and then you have that plus sign like that, you can drag it up to the number of years you actually want, like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5, and you can be able to see the project life right over here is 5 years. So from year 0, and we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings, so shillings, put shillings, and we are saying we can put them in thousands. That all of these need to be put in terms of thousands over here. That why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presented, presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That, and the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the the net cash flows over here, the cash flows. Cash flows. And you're seeing the cash flows over here, we've been given the initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're saying is 25,000. Not right there, you can put, because this is the residual value, the cash flows here, 25,000. That, and we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that. And we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows which you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here I can write now the payback period. Because that's what we're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we are going to pick plus that value plus this net cash flow here comes to 75, and then we reduce it, we continue, we drag it because it has got a formula, we continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A part 1. So this is A part 1. I can just put it like so. This is A part 2. A part 2, like that, so that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that, copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy. Put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows, like that. And then we have this value like that. And this is what you're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are going to, we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or in Excel, there's always a way we can be able to get the present values, always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2 power 3, power 4 and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here. That. So these represent the net cash flows. So this is what we're seeing is shillings. So just delete this, and it's okay. But the initial investment picks from here. The net cash flows. That value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here, like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So he picks arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%. Oh, it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%. 14%. Like that. 14%. 15%, and so on and so forth. Just come and change here. 16%. 17. That, then 18. So don't worry about that. 19. Then here we got 20%. 20%. Like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the Business and Data Analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
Greetings, candidates, and welcome to the lesson. We are going to study the internally generated funds and the externally generated funds under the topic, the financing decision. These are two broad categories of financing sources for enterprises. And understanding the distinctions between the internally generated funds and the externally generated types of funds is crucial for effective financial management. So we are going in our today's lesson to do a comparison between internally generated funds and externally generated funds. That's what we'll study in our today's lesson. Externally generated funds. We'll first of all look at the internally generated funds. Now, our distinction will be based on certain features or characteristics, like the source. Source. Let me put it down here. Source. What is the source of internally generated funds or origin? Candidates, internally generated funds, as the name suggests, originate from within a company's own operations and activities, and is primarily composed of retained earnings, accumulated reserves, depreciation funds, and so on. These funds originate from companies' own operations. The origin, the source, originates from companies' own operations or activities. Source. I've given examples. The retained earnings, accumulated reserves, retained reserves, accumulated depreciation funds, and so on. We can also distinguish internally generated funds from externally generated funds on the basis of ownership. 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 Now, internally generated funds do not dilute the control ownership or ownership control of existing shareholders. Do not dilute the ownership control. These internally generated funds do not dilute ownership control. But the externally generated funds, they dilute the ownership control. They do what? They dilute the ownership control. Internally generated funds originates from companies' own operations and activities, but externally generated funds originate from outside. They come from outside sources, like debt financing, like equity financing, and various other capital sources. But internally generated funds, these are funds that originate from within the company's operations and activities. Number two, ownership. Internally generated funds do not dilute ownership control, whereas externally generated funds dilute ownership control. We can also distinguish the two on the basis of cost. Cost. And when we are referring to cost, we can mention something on the cost structure. Generally, internally generated funds do not involve explicit costs, like interest payments, like dividends, and so on. They do not involve explicit costs. Do not involve explicit costs like interest payments, dividend payments, and so on. But externally generated funds involve explicit costs like interest, like dividends, and so on. Cost structure. 4, flexibility. Flexibility. Now, internally generated funds as a source, this source of funding, this source of finances from within the company provides greater flexibility in decision making. Provides greater flexibility in decision making. Provides greater flexibility in decision making. Why? Because the company is not bound by external debt covenants or the expectations of external investors. The company is flexible. If the company wants to use retained earnings, does not need approval from external people or providers. So it's more flexible. These sources, internally generated funds, these sources of funds are generally flexible compared to external sources. Five, stability, financial stability. Now, relying on internally generated funds, when a company relies, let me put it this way, when a company relies on internally generated funds, such a company enhances financial stability, especially during economic downturns. Why? Because the company is less dependent on external sources, is less dependent on the external markets for financing. It's more, provides more stability. Okay? Do you understand? Relying on internal funds enhances financial stability. Enhances financial stability. Do you understand? As you are going to see, as you compare the two, let me have another column here for comparison purposes. This is a column for internally generated funds. You can have another one here for externally generated funds. Number one, on the basis of the source, distinguishing the two, internally generated funds originate from companies' own operations. For externally generated funds, these funds originate from outside the company. From outside, like debt financing, hire purchase, and so on. These funds are originated from outside, and they comprise funds raised through loans, bonds, equity issuance, venture capital, private equity, and other external financing mechanisms. We also distinguished the two based on ownership, and we stated here that internally generated funds do not dilute ownership control. But externally generated funds often involve external investors or creditors, leading to potential dilution of ownership control. This one leads to dilution of ownership control, because new investors are brought into the company, and the existing company, the existing shareholders do not enjoy a monopoly in ownership. The ownership is now shared once new investors are brought on board. Do you understand? Number three, we saw here that internally generated funds do not involve explicit costs, but external funds typically come with explicit costs such as interest payments for debt or dividends for equity. These funds come with explicit costs. I've mentioned interest payments, dividend payments, and so on. The other distinction is based on flexibility. We saw that internally generated funds provide greater flexibility in decision making, provide greater flexibility in decision making. But for externally generated funds, there are constraints. External financing may come with specific terms and conditions, may come with covenants, may come with expectations, and companies may have to adhere to certain constraints imposed by creditors or investors. External generated funds come with constraints, There are decision constraints. External financing may come with specific terms and conditions. Terms, conditions come with terms, conditions, covenants, and so on. There is no flexibility in decision making. A company is not free to make decisions when involving external investors, like debt covenants, where maybe the assets of the company are charged on the basis of the debts. A company is not free. So here there is less or no flexibility. Little flexibility, no flexibility compared to internally generated funds. Do you understand? Then there is the aspect of stability. Internally generated funds enhances financial stability, But for externally generated funds, there is what we call market dependency. The company depends hugely on the market. Companies that rely heavily on external financing may face challenges during economic downturns or in volatile markets, such as where external funds are subject to market conditions and investor sentiments. Do you understand? So these are four four points to illustrate the difference between externally generated funds and internally generated funds. And when deciding on whether to opt for internally generated funds or the externally generated funds, there are other considerations that the company can put into that could consider. There are considerations that the company has to look at, like risk and return. The decision to use internal or external funds may depend on the risk tolerance of the company and the return expectations of the investors. And we know that external financing may offer higher leverage, but also provides higher risks and costs. Another factor to consider when selecting either between internally generated funds or externally generated funds is the growth and expansion. For substantial growth initiatives or capital-intensive projects, companies may resort to a combination of internal and external financing. Why? In order to meet their funding requirements. So we discussed 4 points that has helped us understand the distinction between internally generated funds and externally generated funds. The first distinction is based on the source. You say that internally generated funds originate from the company's own operations and activities, but externally generated funds are originated from outside the company. Number 2, the second distinction is based on ownership. Internally generated funds do not dilute ownership control, whereas externally generated funds dilute ownership control. Point number 3 was based on the cost. We saw that the internally generated funds do not involve explicit costs, but externally generated funds come with explicit costs like interest payments and dividend payments. Number 4, fourth distinction is based on flexibility. Internally generated funds provide greater flexibility in decision making, but there are constraints when it comes to externally generated funds. Then lastly, the first point distinction is based on stability. Internally generated funds enhances financial stability, whereas the externally generated funds depend on market conditions. There is market dependency. Companies relying heavily on external financing may face challenges during economic downturns or in volatile markets, because such funds are subject to market conditions and investor sentiments. That is the end of today's lesson. Allow me to read 3 questions for your revision. 1. What are the advantages and disadvantages of relying on internally generated funds as a source of financing for enterprises? Number 2. How can enterprises effectively tap into externally generated funds, and what are the various external sources available to businesses for financing? 3. In what situations would a company prefer internal financing over external financing, and vice versa, considering the impact on business operations and financial stability? Thank you for attending the lesson. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? we want to pick the average for Z term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we are saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we are saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here compared to us over here, but now we need to factor in the weights. and we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with co-assemblers corresponding portfolio composition weight. We open the brackets, we pick ujenzi bora standard deviation, weekly standard deviation, times the ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So you pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or variance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var P but var S, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. There, that's our beta, 0.0932. And if you are to drag it moving towards the right, Let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1 because it's covariance of the market. It's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi students, welcome to another session of Manifested online classes. So in this session, I want us to continue with the topic on farm accounting or accounting for agriculture activities. And specifically, I want us to do an illustration question regarding preparation of financial statements. But before you do that, there is a question which I want to give as an assignment. That is a question for April 2023, question number 5A. You check on that particular question, it was requiring you give some provisions of IS 41 as far as the measurement of agricultural produce are concerned, and also the disclosure requirement, the information to be disclosed if the fair value of agricultural produce cannot be ascertained reliably. So make sure you attempt that particular question. Equally, if you'll have a challenge in terms of answering that particular question there, I usually encourage my students to acquire this particular revision kit or this revision partner for Manifested Publishers. You'll be able to get now the solution for the same at the end of that particular book. So therefore, make sure you look on that particular question there. Now, for the purpose of illustration regarding preparation of financial statements, I want us to look on a question which is here, and I can go through it. And the question reads: the trial balance was extracted from the books of David Wekesa, a farmer, as at 31st of October 2019. So we are given the inventory that is on 1st November 2018. This is now the opening inventory for dairy cattle, maize which is growing, dairy cattle feeds, fertilizer for maize, landed buildings, tractors, other cattle which are bulls, and then we have cats which is the net book value purchases for dairy cattle, fertilizer for maize, fertilizer for napier grass, and then we have maize seeds, dairy cattle feeds. We have sales for milk, dry maize, green maize, dairy cattle manure, and then we have crop expenses which include labor and other expenses, napier grass, labor. We have the general expenses. Then we have trade payables. We have capital as all on 1st November 2018, cash at bank, and then we have dairy cattle expenses which include manure, not manure rather. We have medicine. We have labor, other expenses. Then we have some additional information. Number one, you're given the inventory as at 31st of October 2019, which included dry, that is dairy cattle, maize, which is growing, other cattle which are bulls, dairy cattle feeds, and then we have fertilizer for planting maize. We have some additional information. Number two, we are told during the financial year which ended 31st of October 2019, the following distribution of farm produce were made. So we have the farm produce which were consumed by the family members, and then we have the milk delivered to relative, hotel. You have to remember how we treat such farm produce. One farm produce which are consumed by the family members. We said this is accounted for as sales and also accounted for as what? As drawings. And then we have the milk which is delivered to relative hotel. These like farm produce which are delivered or given to close relative. One, we account for that as sales, and two, we account for that as an expense in the general income statement. Number three, we are told manure valued at 600,000 removed from the cowshed and used in the maize plantation. This is what we refer to as the interdependence of department. Output from one department is an input in another department. So in this case, we said the producing department should account for that as sales, whereas the using department should account for that as purchases. Then we have the maize stock valued at 1.5 million used as dairy cattle feed. The same case in the interdependence of department. The producing department account for that as sales. The using department account for that as purchases. Then we are told cattle bulls are used for pulling carts. So basically carts majorly are used in the farm, and what that means that these particular bulls then are used in the farm. Any information relating to the bull basically will be recorded in maize, or not in the maize lather, in the crop revenue account. And then number 6, you are told depreciation is to be provided on tractors and carts on the reducing balance method at the rate of 25% and 12% per annum respectively. Number 7, you're told income tax is estimated at 3.6. So what you're required to do here, Roman 1, is we prepare revenue accounts. You can see not one account, but two accounts. But from the information, or actually from the information which you're given there, it is important for you to note that David Wekesa was involved like in two farming activities. You can see we are given some information regarding dairy cattle, meaning that David Wekesa was involved in dairy farming, and at the same time we are given information about maize which is growing, fertilizer for maize, and so on. So therefore we can say that David Wekesa was involved in some form of livestock keeping, which are dairy cows, and as a result of that we have said that you need to prepare a revenue account called livestock revenue account. Also, David Wekesa is involved in growing of maize. In such a case, you prepare something called the crop revenue account. So therefore, here we're going to prepare two accounts, the crop revenue account and the livestock revenue account. Roman 2, the income statement. This, what in other terms we have referred to as general income statement. And number 3, statement of financial position. So we start with the Roman 1 of that particular question, whereby we are required to prepare the revenue account for David Wekesa. So this is the revenue account. And we have said that the revenue account, this one is prepared using a T format. We prepare this using a T format. This will be the debit side. Whereas this is the credit side. And this particular account will be having two sides. This is the credit, this is the debit. And then we prepare those two revenue accounts concurrently. We have now the crop livestock account. That is the crop revenue account and livestock revenue account. In the same case on the debit side, livestock revenue account and the crop revenue account. The livestock and the crop revenue account. Then the other thing which is important for you to recall here is that in preparing this particular account, we have said on the credit side we record two items. We record the sales and also the opening inventory. On the debit side we record three items: the opening inventory, purchases, and also what we refer to as the expenses, specifically relating to crop and also to livestock. So let's start by recording the sales, and for sales we are given information as far as that is concerned in the trial balance. So we just need to record the sales given here. So we are given the sales one of milk. We are given the sales of milk. So basically milk, this is from dairy cattle. So basically dairy cattle, these are livestock. So therefore that one we record it in the livestock revenue account. And also important for us to note here that all our figures are in thousands of shillings. All our figures will be in thousands of shillings. Will be in thousands of shillings. So then from there we also have the sale of dry maize. Maize is a form of a crop that go to the crop revenue account. And then we also have a sale of green maize, which is still a form of a crop that go to the crop revenue account. Then we also have a sale of dairy cattle. Dairy cattle, these are livestock. These go to the livestock revenue account, which is a figure of 81. And then from there we also have the sale of what? Of manure. Basically manure comes from what? From livestock, from dairy cows, and that is an amount of what? 3,000. So these are the various items of sales which are given. Then from there we need to go back to the trial balance because there are other items which we also account for as what? As sales, like maybe the farm produce which are consumed by the farm workers, by the family members, donated to close relative and so on. So let's go to note number 2. And in note number 2, first of all, we have the maize consumed by family members. Maize consumed by family members. So these we have said is accounted for as sales, and basically these are crops. So that will go to the crop revenue account. We also have milk delivered to relative hotel. Milk to relative hotel. This is also accounted for as sales. As far as the livestock is concerned, this is the agricultural produce from the dairy cows. That is an amount of what? Of 4320. Yes. So we have that. And then note number 3 and 4, we have interdependence of department. So number 1, we have the manure which was valued at 600,000, removed from the cowshed used in the maize plantation. We have said that the producing department now, which is the livestock, will basically account for that as what? As sales. So manure used in maize plantation. So that is sales as far as the livestock is concerned. And that is a figure of 600. And then we also have maize stock. Maize stock used as feeds or used as dairy feeds. So that maize stock is a form of came from the farm. The farming or the crop farming or the maize farming will account for that as what? As sales. That is an amount of what? Of 15. So I think that what we have. Then note number 5, 6, 7 will not affect our sales. So therefore, those are, I think, additional items which you are going to account for as what? As the sales. 1, we have seen. Number 2, the maize consumed by the family members. That is accounted for as sales in the revenue account. Number 4, maize stock valued at 1.5, used to feed the dairy cows. So basically the maize stock come from the farm. That is what? Okay, yes, that will be accounted for as what? As the sales here. As the sales. And then we also have now the manure removed from the cow shed. Yes, so I think that treatment is okay. That treatment is okay. Used in the maize plantation. And also, yes. So then from there, the next item we need to record on this side is the closing inventory. Because I've said in the revenue account, we record 2 items on the credit side. The sales and also the closing inventory. Now for the closing inventory, this one is given in the additional information number 1. So for those particular items, we just need to copy them the way they are, no adjustment. So we have crossing inventory of dairy cattle. Dairy cattle, these are livestock that go to the livestock revenue account. We have crossing inventory of maize which was growing. Maize is a form of a crop that go to the crop revenue account. And then we have a crossing inventory of other cattle, which are bulls. There is some information which are given in note number Note number 5, whereby we are told these bulls are used in pulling carts. Carts mostly will be used in the farm. So therefore, these bulls are used in the farm, and that's the importance of that particular point number 5. So these will go to crop revenue account. And then from there we have crossing inventory for dairy cattle feeds. Dairy cattle feeds. So that got to the livestock revenue account, a figure of 1620. And then we have the crossing inventory for fertilizer for growing maize, fertilizer for growing what? For growing maize. For growing maize. That automatically got to the what? To the crop revenue account, which is a figure of 1080. So those are the various items of crossing inventory we have. They are 5 items: dairy cattle, growing maize, and then we have dairy cattle, we have dairy cattle feeds, and then we have fertilizer for growing what? For growing maize. So that's what we record on the credit side. And then on the debit side, we record 3 items: the opening inventory. Then I've said we also record purchases and the expenses specifically relating to crop and also what? Livestock. So for this opening inventory, this one is given in the trial balance. So it's just a matter of transferring those particular figures here. And that is the first item in the trial balance. We have the opening inventory for dairy cattle. That go to the livestock revenue account, 54,900. Then we have opening inventory for growing maize. That got to the crop revenue account, 36. And then we have dairy cattle feeds. That got to the livestock revenue account, 2520. And then we have fertilizer. This fertilizer is for growing maize. So that got to the crop revenue account, 1980. So those are the various items of opening inventory. Then the other item which we also record on this side are purchases. Purchases, first of all, we have the purchases in the trial balance. We have purchases of dairy what? Dairy cattle. Automatically that got to what? That will go to the livestock revenue account, 10,440. We have purchases for fertilizer. So some of the fertilizer is for maize, meaning that will go to the crop revenue account, which is a figure of 2160. We also have fertilizer for napier grass. We know that napier grass, this is for feeding the dairy cows. So that will go to the livestock revenue account. And then we have purchases for maize seeds. Maize seeds that go to the crop revenue account, which is a figure of 1080. And then we also have purchases of dairy cattle feeds. Dairy cattle feeds, which is a figure of what? Of 6120. Yes, so those are the various items of purchases given in the trial balance: 10,440 for dairy cattle, fertilizer 2160 for maize, for napier grass 4,000,
1080, which is maize seeds, and then daily cattle feed 61 what 20. Yes, so those are the items of purchases. But equally, in the additional information, we have some items of purchases, and basically what you check in the additional information is interdependence of departments. So in our case, we know note 3 and note 4, we are given information about interdependence of department. Remember, we have said this whereby output from one department is the input to the other. We have said the producing department will account for that as sales, but now the using department will account for that as what? Purchases. So let's go to note number 3. That manure which was removed from the cow shed and used in the maize plantation will be accounted for as purchases here. So we have what? We have the manure which was used in the maize plantation. Which was used in the maize what? Plantation. Which department will account for that as purchases? It is the maize farming or the crop farming. Whereas now we have seen that the producing department, which is now the dairy farming, account for that as sales. Then number 4, we have maize stock. Which is used as dairy cattle feeds. So maize stock come from the farm. This will account for that as sales. The maize farming department will account for that as what? Or in the crop revenue account, we account for that as sales. Whereas now the using department, the consuming department, which is dairy farming, will account for that as what? As purchases. As what? Purchases. So I think those are now the 2 additional items of purchases which we have. And finally, what we record on these in this account on the debit side are expenses. Specifically relating to crop and livestock. Remember, the expenses which you record here are the specific, not the general expenses. So which expenses do we have here in the trial balance? Let's go through the trial balance. We see which expenses we have. Maybe starting up there, we have inventory. The first item in the trial balance, it is inventory. Below that, we have land, tractor, other cattle, cats. All those are assets. Purchases, we have dealt with that. We have dealt with the sales, and then we have the crop expenses. These are crop expenses, and these we have labor and other expenses, and these expenses we are told relate to crop. So therefore, we record that in the crop revenue account, a figure of 6480 and a figure of 720. Okay, so then from there we have napier grass labor. So basically we know napier grass is for feeding what? The dairy cows. So this is an expense relating to livestock. Napier grass labor. That go to the livestock revenue account. And that is a figure of what? A figure of 1,000. And then from there we have now the general expenses. General expenses, these will go now to the general income statement. We'll go to the general income what? To the general income statement. From there we have payables, capital, cash at bank. Then we have dairy cattle expenses. Dairy cattle expenses. Dairy cattle expenses are expenses specifically relating to livestock. So we have number 1, medicine, which is a figure of 1080. We also have labor, which is a figure of what? Of 9480. And then we have other expenses. Which is a figure of what? Of 1440. Yes. So those are the various items of expenses, or the specific expenses which we have. So basically what we need to do is now we balance our revenue account so that we can be able to determine the profit or loss of each department, department. So let's start by balancing the crop revenue account. And what we need to do is to get the total on both the debit and what? The credit side. So we start by getting the total on the debit. So let's start by getting the total on the debit side. So we have a figure of what? A figure of 3600. Then we have another figure for 1980 plus 2160 plus 1080 plus 600 plus 6480 plus 720. 720. So the total on the debit is equal to 620. What about the total on the credit? So we have 36,000 plus 11,340 plus 1080 plus 1,500 plus 2,700 plus 5,400 plus 1080. Yes, that will give us 59,100. So out of these particular two totals, we pick the one which is higher than the other, which is 59,100, and we record it here in our totals on both sides. On both sides, both the debit and the credit side. So we know that once we add all these, it will give us now 59,100. But now if we add what we have on the debit, is not coming to that, but rather it is coming to 16,620. So the difference, which is 42,480, 42,480, this is now the profit from that department. So from that department of crop farming, we can say Wekesa had a profit. So we do the same. We balance now the other account, the other revenue account, that is livestock. So let's first of all get the total on the debit side, 54,900 plus 25,20 plus 10,440 plus 4,000 plus 61,20 plus 1,500 plus 1,000 plus 1080 plus 9480 plus 1440. So that is giving us 92,480. And then let's get the total on the debit side. Sorry, on the credit side, we have 27,360 plus 8,100 plus 3,000 plus 4320 plus 600 plus 54,000 plus 1620. Okay, so let's take that again. Yeah, it is coming to 99,000. 99,000. It's okay. 99,000. So basically from that, the amount which is more is 99,000. We record it on both sides. 99,000. 99,000. But I think we can just confirm that. We can just confirm that for accuracy purpose. Can just confirm that. Is coming to 99,000. So the difference between the two now minus 92,480. So it's coming to 6520. So these whatever you have here, this is basically now the profit for the year from now those particular two what? From those two departments, So basically that question was given how many marks? 6. So these are the items generally which are marked. If you are able to record now the sales and also the closing inventory on this side, and also in the correct revenue account, so basically you get now a mark. You get a mark. You can see these are questions with so many entries. So by doing that, you get now your 6 what? Your 6 marks. So then from there, let's proceed and prepare now the income statement. In part A, not Patel, other Roman 1 of that particular question. Let's move to Roman 2, whereby we require to prepare now the income statement of David Wekesa, which is for the year which ended 31st of October 2019. 31st of October 2019. So this one is quite simple because we said that this one is prepared now to ascertain the entire the performance of the entire business of Wekesa. Is not prepared to ascertain the performance of each department, but prepared to ascertain the performance of the entire farming business undertaken by David Wekesa. And therefore, we have said in terms of how we prepare this, we take the incomes of David Wekesa from his farm, and then we less all what the expenses. So what we start with here are the incomes, and basically I've said always we start from this we start with this particular profit from these two departments. So we have the profit from the crop revenue account and also from the livestock revenue account. So we have profit from the crop revenue account of 42,480, from livestock 6520. Yes, and then out to this we add other incomes. So what you need to check is whether David had any other income. You go back to the trial balance and basically check the items on the credit side of the trial balance. And I think up there I can see we have what, or basically on the credit side I think we have sales, which you have already considered as an income, and then payables, capital. None of those items is an income. So mean that David didn't have any other source of what? Income. So let's add the two figures so that we can get the total income of David. Okay, this will give us a total figure of what? A total figure of 49. And then to this, or basically this is now the total income. So to this we proceed and we less what? We less the expenses, and the expenses which we have we deduct here are the general, the expenses not relating to these farming activities, not relating to crop farming, not relating to livestock, but these are the general expenses which are incurred. Maybe you can start from the additional information. In the additional information number 1, we have closing inventory. Additional information number 2, we have this particular milk which is delivered to relative hotel, milk delivered to relative hotel. Essentially what I've said is that any farm produce which is like donated, which is given free of charge, is accounted for as an expense here. But now that particular maize which is consumed by the family members, we say it is accounted for as sales here, and then as what? As drawings. So then we have note number 3, 4, 5. Okay, those will not affect this general income statement. And then we have now note number 6, we have depreciation on tractors, which is now at the rate of 25%, and also depreciation on carts. Carts, these one are like mkokoteni, which are used in the farm. So basically we need to compute now their depreciation, and we are told this depreciation is on the net book value. So what is the net book value of these two assets? So the net book value of tractors is what is 32,400. 32,400, and for the other one is 6,000. So this one we can say just 3,600. 3,600, and 12% of 6,000. Okay, let me confirm that. It should be 12% of 6,000. Yes, that will not be 36, but rather it will be 720. So this will be 720. What about 25% of 32,400? This is 8,100. Yes, so that depreciation is a general expense. Okay, so then from there we have number 7. Number 7 is about tax. Is still an expense, but first of all we have to compute the profit before tax. Then we proceed and less what? Tax. So what then we need to do? Can we go back to the trial balance? We check whether we have any other general expense, and I think we only have one general expense, which in the trial balance is given, is referred to as the general expense. The general expense or the general expenses, which is a figure of 800. So we need to get the total expenses, and then we less that from our total income. So we have 4320 plus 8100 plus 720 plus 10800. That will give us a total of 23,940. So we less that from our total up there, and we get a figure of 25,060. So this one we refer to it as profit before tax. Remember, in the additional information number 7, we are told we are given estimated income tax. So what we need to do, we less the estimated income tax, which is a figure of what? Of 3,600, and then we will get the profit for the year. The profit for the year. Profit for the year. This one will be how much? We have 25,060 minus 3,600. Yes, that will give us a figure of 21,640. So that is it. That what was required as far as that Roman 2 is concerned, and the marks are located. There were 6. So definitely the items which were marked is what we have there. So by doing that, you get now your 3 marks. So finally, Roman 3, we are required to prepare the statement of financial position, statement of financial position as at 31st October 2019. So this one is a statement of assets, liabilities, and what? And capital. So we start by recording assets. Specifically, we record always. First of all, we record non-current assets. So for non-current asset, I think we have a number of them. In the trial balance, you have to record that all assets have a debit balance, and I think we can start from where we have land and buildings. Land and buildings. So for added buildings, I hope you can see they are not depreciated. So for the value for added buildings remain the same as 90,000. Then below that we have tractors. We have tractors. Tractors, we are given their net book value as 2,400, but these tractors during the year they depreciated. They lost a value of 81. So we have to less that depreciation there, so that we get their net book value at the end. We are going to compute that, and then from there we have other cattle, which are bulls. So remember, these are still assets. Specifically under IAS 41, we refer to them as biological assets. Biological assets. So they have a value of 6,000, and then from there we have cats. Cats, we are given the value as what? As we are given the value as what? As 3,000. 3,000. So meaning that there is something we need to correct here. This value is not 6,000. but rather it was 3,000. 3,000. So let's make that small change here. We took the wrong figure, so meaning that we have 12% of 3,000. 3,000. So that will be, this will be 360. 360. So we can correct this, which will be 23,940 minus 720 plus 360. That will be 23,580. 580. So we less it from that figure up there, 49,000. So which will give us 25 for 20, and then minus 3,600. Yes, so this will be 21,820. Yes, so that should be the correct thing. So I've taken the wrong figure for cuts there, 6,000 instead of 3,000. So that will be cuts 3,000. So we less their depreciation here of 360. 360. Okay, so maybe you can just confirm whether we have any other item of non-current assets. Any other item of non-current asset in the trial balance, and I don't think so. So let's get now get the final figures here for these two assets, starting with tractors. Tractors, we have 32. We have 32,400 minus 8,100, which will give us what? Which will give us 24,300. And then we have cuts. We have 3,000 minus 320, which will give us what? 2640. 26 what? 40. 2640. Okay, I'm trying to counter check whether we have any other item of non-current asset. I don't think so. Yes, so next we record current assets. We record current assets. So for current assets, what do we have here? In the trial balance, we check the items on the debit side. What can I see? I can see cash at bank. Cash at bank, which is a figure of 15,300. 15,300. Yes, I think that is the only item we have in the trial balance. But now in the additional information number 1, we have the crossing inventory. Crossing inventory. So we have various items of crossing inventory which include daily cattle. Daily cattle having a value of 54,000. We then have growing maize having a value of 27. We have other cattle which are bulls having a value of what? A value of 54. And then we have daily cattle feeds. Daily cattle feeds having a value of 1620. And then we have fertilizer for planting maize, which is 10 what? 1080. So those are the various items of crossing inventory we have in note number 1. Note number 1, 1080, 16, 20, 54, 27, 54,000. Okay, number 2, number 3, number 4. Yes, so we don't have any other item of current assets. So what we need to do is to get the total assets. Let's get the total asset. We add all these particular assets we have here, starting from what we have here at an current asset. We have 90,000. We have the other item 24,3, 6,000 plus 2640 plus 15,300, 300 plus 54,000 plus 27 plus 54 plus 1620 plus 1080. Yes, that will give us a total of 203,040. And then from there we record the financials, which include capital and what? Liabilities. So we start by recording capital, which is the first, actually not the first, but we have it in the trial balance as a figure of what? We have capital in the trial balance as a figure of 163,080. So to this, what do we add? We add the profit for the year. The profit for the year from the income statement, this one, which is 18 what? That is 21,820. And then to this, because this is a sole proprietorship business of David Wekesa, we less any drawings. And in the trial balance, we don't have drawings, but we have the information we have in note number 2 about the maize consumed by family members. We have said any farm produce consumed by the family member, we account for that as sales in the revenue account, and then we account for it as drawings here. So 1080. So then what do we get? We get the net capital at the end of the year. The net capital at the end of what? Of the year. So we have capital, which is 163,080 plus 21,820 minus 1080, which will give us 183,820. And then to this we add liabilities. So always we start with the non-current liabilities. Because these are a sole proprietorship business, the only non-current liability which a sole proprietor may be having is a bank loan. Do we have a bank loan in this question here? No. So meaning that here we don't have any non-current liability. Finally, we record the current liabilities. For current liabilities, let's start with what we have in the additional information. Additional information number 7, where we have the income tax. That income tax was not yet paid, and that's why it is given as part of the additional information. If it had already been paid, then it should be part of the trial balance. So take into account it had not been paid, it will be one of the current liability. And then in the trial balance, we have the trade payables. We have trade payables of 15,620. Do we have anything else? Do we have anything else? No. So what we need to do here is we get now the total. We get the total. We get total, capital, and liabilities. Total, capital, and liabilities. So we add those three items: 183,820 plus 3600 plus 15,620, and that is giving us the same figure of 203,040 as what we have there. Is what we have there. So that is it. That basically what was required in that particular part of that particular question. And equally, the marks which were located there were how many marks? Were 3 marks. So those are the items now which were giving those 3 what? Those 3 marks. So that basically brings us now to the end of that particular topic relating to agriculture or accounting for agriculture activities, or accounting for farming activities. We have been able to discuss a number of issues. We have discussed what is biological asset, the recognition criteria, the initial subsequent measurement, and also we have looked on the financial statements prepared by an entity or basically a company involved in some farming or agriculture activities. Equally, you have looked on an illustration, and also there is another question which I've given as an assignment. Make sure that question which I've given as an assignment you attempt it. So we stop at that point. See you in the next class as we discuss the next subtopic. Hi Rana, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Financial Reporting and Analysis. So in this session, I want us to look on an illustration question regarding accounting for the conversion of a partnership into a limited company. And I want us, first of all, we go through that particular question and we see what was required. So the question reads, Chada, Pete, Kidore are partners in a partnership business, sharing profit and losses in the ratio of 2:2:1 respectively, after allowing for a 10% per annum interest on fixed capital balances and commission entitled to a partner. The following trial balance was extracted from financial record of partnership as at 30th of September 2017 is as set below. So we are given the trial balance there for partnership as at 30th of September 2017. So the first item, we have landed buildings at cost, motor vehicle at cost, office equipment at cost, furniture and fixtures at cost. And then we have the provision for depreciation for buildings, motor vehicle, office equipment, furniture and fixtures. So this is the accumulated depreciation for those particular assets. Then we have investment. We have goodwill, inventories as at 30th of September 2017. We have account receivable, account payable, bank overdraft, accrued expenses, a capital account for Chada, Pete, and Kidore. And then you're given the net profit for the year which ended 30th of September 2017. We have the drawings by the three partners, Chada, Pete, and Kidore. And then we have the current account for the three partners, Chada, Pete, and Kidore. Then we have some additional information, note 1 up to note number 3. Note number 1, we are told that Kidore was the only active partner and was entitled to a commission of 15% on annual sales revenue, which averaged to 20 million. So, and then you're told that number 2, the partners resolved to convert their business into that of a company to be named Chapeki Limited with effect from 1st October 2017 under the following terms. 1, we are told investment comprised equity investment, which partners had acquired jointly. Each partner was to take over a portion of the investment equivalent to the profit share. The investment had a market value of 50 million as at 30th of September 2017. The other point, you are told other assets and liabilities were transferred to the new company at the following agreed values. Landed building 115 million, motor vehicle 25.5 million, office equipment 43.5 million, fixture and fittings 29.55 million, and then inventories at a book value less 5%, account receivables at book value less 2.5%, and then we are told current liabilities were transferred now to the company at their book value. We are told goodwill was considered valueless and therefore was written off. And then you're told the purchase consideration on business purchase was agreed at shillings 250. And the last point of note number 2, we are told the partners were to become shareholders. The company issued ordinary shares at par of shillings 10 each to the partners to satisfy the balance due to them as at 30th of September 2017. And in the last point, number 3, we are told upon incorporation, the new company issued new debentures at par carrying a 14% per annum. And then you're told the cash proceeds from the issue amounting to 50 million were utilized to purchase additional stock of raw materials, additional stock of raw materials worth 15 million, and then you're told accrued expenses were settled in full. So what you are required from this particular question one is we prepare the realization account, partners capital account, and Chapeki limited account to cross off the partnership books, and finally we are required to prepare opening statement of financial position of Chapeki Limited. This is a question for conversion of partnership into a limited company. Basically, what we said in our first lesson is that whenever a partnership business has been converted into a limited company, the first thing we need to do is to cross off the books of account of the partnership business, simply because that partnership business is dissolved. And actually, we said we prepare three main accounts: realization account, partners capital account, and the purchasing company account. Like in this case, the purchasing company is known as Chapeki Limited. Those are the three main accounts which we prepare to cross off the books of account of the partnership. And actually, that is what the examiner was requiring as far as Roman 1 of that question is concerned. And then from there, we proceed and then do what? Open the books of account of the new what? A company. So therefore, what we need to do is to start with Roman 1 of that question, whereby we are required to prepare a number of accounts. So the first account we are required to prepare is the realization account. Realization account, that is the first account we are expected to prepare here. And the realization account, basically this is prepared using a T format. Also in Roman 1, we are required to prepare a partners capital account. Partners capital account. Partners capital account. Equally, this is a T account. A T account. So meaning that this account will be having a debit and a credit side. And on the credit side, we are going to have the details column and columns equal to the number of partners. In our case, we have three partners. That is, we have three partners, Chada, Pete, and Kidore. The same case with the debit side of this particular account, we have three columns for the three partners. This is the debit side, credit. The same case with the partners capital account. So this is the details column, and then we have three partners, Chada, Pete, and then we have Kidore. The same case on the debit side, Chada, Pete, and Kidore. And equally in Roman 1 of that particular question, what the examiner was requiring us we prepare is another account which is called Chapeki Limited. So remember, Chapeki, this is a new company, and basically the new company we refer to it as purchasing company. Reason being that this particular company is purchasing the business of the partnership. So therefore, we have the other account which is Chapeki Limited account. Chapeki Limited, but which you are saying is the purchasing company. Purchasing company account. Purchasing company account. So those are the three accounts which the examiner requires to be prepared as far as Roman 1 is concerned. And these accounts basically are prepared in order to cross off the books of account of what? Of the partnership. So what we need to do before we cross those particular accounts of the partnership, maybe we can just go through the additional information. We see what we are told. And number one, you're given some information about the commission which Kidore was to be entitled to, which you're told it was 15% of the sales revenue. And we are told Kidore is entitled to that commission because he was the only active partner. Being active partner means that Kidore is the one who was running the affairs of this particular partnership business. So we have that information, and then in number 2, we are given now the information or the terms of conversion, the asset which were taken over by the new company, the asset which were taken over by the partners, the purchase consideration, and so on. So therefore, what we need to do, or anytime you come across such a question for partnership and whereby the conversion is taking place at the end of the year, the first thing you need to do is to distribute or basically to appropriate the profit which was reported by this particular partnership business among the partners, partners. Once you're through with that, then proceed and you cross off the books of account of what? Of the partnership. And basically, in this case, we do that by preparing something called the appropriation account, so that we can be able to do what? To distribute now that particular profit which was reported by the partnership business among the partners. So therefore, let's first of all we do that. Before then, we can proceed and cross off the books of account of this particular partnership business. It is also important for you to note that the figures which are given in the trial balance are in thousands of shillings. So therefore, what we need to do, first of all, we take the net profit which was reported, the net profit for the year, and the net profit for the year in our case we are told is 91,000. So remember, take into account this is a partnership business. This profit which was reported during that year should be shared among partners. But before sharing out that particular profit, there are a number of things we need to deduct from this particular profit, things like interest on capital, things like salaries to partners, things like commission to partners, and so on. So in our case, what you're given in the additional information, number 1 is the commission to Kidore. So mean that here we list now the appropriations. So the first appropriation we are going to list is the commission to partners. So in our case, we know that it is only one partner who is entitled to a commission, and that is Kidore. Kidore was entitled to a commission equal to 15% of the sales. And in this case, we are told the sales for that year average to how much? Average to 20,000. So we get 15% of that, and automatically that should give us 3,000. Let's just confirm whether that will give us 3,000. So 15% of 20,000. Yes, that will give us 3,000. So this is a commission now which Kidore was entitled to. The other appropriation which we deduct from this is salary to partners. Salary to partners. As per the information which are given in this particular question here, there is no partner who was entitled to a salary. But if any of the partner was entitled to a salary which is an appropriation, we also deduct it here. The other appropriation which we deduct here is something called the interest on capital. Interest on capital. There is some information which are given regarding this, which is in note number or in paragraph 1 of that particular question, whereby we are told partners were sharing profit and losses in the ratio of 2:2:1 after allowing a 10% per annum interest on fixed capital balances. So mean that the partners were entitled to an interest of on capital equal to 10%. So let's compute the interest on partners, or the interest on capital, that is for each partner. For a Chada, which will be 10% of his capital. Then we have Pete, equally 10% of his capital. And then the last partner, who is Kidore, equally 10% of his what? Of his capital. So how much is the capital balance for each partner? We have that is in the trial balance. And the capital of Chada here was 58,500. For the other partner, it was 37,000. That is Pete. And the other partner, that is Kidore, we have an amount of 31,500. So what we need to do, we get 10% of this. So this will give us 58,50. This will give us is 37. It will give us 3,700. And then this will give us 50. So we get the total. We take it to the last column. So the total figure here will be 5850, 50 plus the 3700 plus the 3150. That will give us 12,700, and equally that one should be deducted now from our net profit. Now, after deducting those three items, that is the commission to partners, the salary to partners, the interest on capital, the amount now which remains here, or basically the balance which you get, if a positive figure is a profit to be shared, but if it is a negative figure, is a loss now to be shared. In our case, I hope you can see here, definitely you are going to have a positive figure. So this minus those two figures, we are going to have a positive figure. We less from 91,000, we less 3,000 and 12,700. Yes, that will give us a positive figure of 75,300. Now, this particular figure here, this is a profit now to be shared by partners, or to be shared among the three partners using their profit and loss sharing ratio. So therefore, we have the share of profit, and this profit will be shared by the three partners. Chada, I think we can just use C for Chada, P for Pete, and K for Kidore. And this particular profit will be shared based on their profit and loss sharing ratio. As per the information we have in the first paragraph of that particular question, we are told that the partners were sharing profit and losses in the ratio of 2:2:1. So we need to get the total for that, which is 5, and the share of Chada is 2/5 times that figure, that is 75,300. The same case with Pete, 2/5 times 75,300, and then finally Kidore, 1/5 times 75,300. So that will give us now the amount of profit which each partner was entitled to. So the first partner, we take 2/5 times 75,300, and that will give us 3120, and that's the same for the other partner. And the last partner will be entitled to a share equal to a profit share equal to 15,060. So then once we add all this, it should give us now this particular amount here, that is 75,300. Yes, and basically after deducting now these three items now from our profit there, we should get now 0. Maybe you can just confirm 91,000 minus 3,000 minus 12,700 minus 75,300. Yes, so that should give us 0. So that is the first thing you do. You take the profit now which was reported by the partnership, and then you do what? You distribute it among the partners. And once you do that, then you go back to the trial balance, and basically you cross off all those particular accounts which had balances at the end of the year, starting from the first item there, which is land and building. But even before you do that, you have to remember, we say that in preparing this particular account, there are a number of things which you record here. For example, when we say that all the assets which are taken over by the new company at their net book value, we debit them in this particular account. The other item, or basically on the other hand, we say that those particular assets which are written off, those particular assets which are taken over by partners, we debit them in this particular account. Also, in the realization account, we credit the liabilities which are taken over by the new company, and also in this particular account on the credit side, we record now the purchase a consideration. So therefore, what we know as per the information we have in or as per the information we have in note number 2, is that a number of assets, including land and buildings, motor vehicle, office equipment, furniture and fixtures, inventories, account receivables, all those particular assets were taken over by the new company. So therefore, all those particular assets which were taken over by the new company, what we do is that we debit them in this particular we debit them in this particular account here. We debit them in this particular account here. The first asset is land and buildings. Land and buildings. and we debit that particular asset here at its net book value. So what will be the net book value? The net book value will be equal to the cost, which is 123,500 minus the accumulated depreciation, which is 20,150. So that will give us now the net book value. We're going to compute that. The other asset is a motor vehicle. So the net book value is 80,600 minus the accumulated depreciation, which is given as 54,600. The other asset which was still taken over is office equipment. The net book value will be 70,200, which is the cost, minus accumulated depreciation, which is 24,400. The other asset which was taken over was furniture and fixtures. The net book value will be 52 minus the accumulated depreciation of 18,500. So these are basically the assets now which were taken over by the new company, and those particular assets we have said in this particular account we debit them. We debit them at the net book value. At the net book what? A value. So let's compute the net book value of this particular asset, starting with the first one, which is landed building 123,500 minus 20,150, which will give us 103,350. The other one is a motor vehicle. We have 80,600 minus the accumulated depreciation of 54,600, which will give us a net book value of 26,000. So the other asset is office equipment, whose cost is 7,200 minus accumulated depreciation of what? Of 24,400. That will give us 45,800. And then we have the other asset, which is furniture and fixtures. The cost is 52,000 minus accumulated depreciation of 18,500, and that will give us 33,500. Yes. So we are through with those particular accounting for those particular assets which were taken over by the first of all, those particular non-current assets which were taken over by the partnership, and then below those particular assets. Remember, I've said we cross off those particular accounts. Don't skip any account. So then from there we go. Remember, you have dealt with those particular accumulated depreciation. Then from there we go to the investment. So there is some information you are given regarding those investment in point number 2. In addition information number 2.1, we are told investment comprised of equity investment, which partners had acquired jointly. Equity investment means that this is an investment in shares, and the partners had acquired those particular shares what? Jointly. So we are told each partner was to take over a portion of the investment, equivalent to the profit what? A share. And then you are told the investment had a market value of 50 million at on 30th September 2017. So this particular investment, which we are told include investment in equity shares. So in the statement of financial, in the trial balance, you can see that this particular investment had a book value of what? Of 44,800. But you are told this particular investment at the end of the year had a value of how much? 50,000. So automatically, this particular investment will be shared by partners at their market value. The market value is how much? 50,000. So, but now the difference here, which is the difference between 50,000 and 44,800. So this one, which is 52, is what? Is a gain on investment, or basically we can refer to it as a revaluation gain on what? On investment. So how do we account for that? So remember, investment, this is an asset. So therefore, the amount which was recorded in this particular account was an amount of how much? 44,800. Yes. So therefore, what we do, because we need to cross off that particular account, take into account those particular investments were taken over by partners. So we credit this particular account with that particular amount, 44,800, and now this particular gain of 5,200, this will be credited in this account. This will be credited in this what? account. So basically what that means is that the double entry for this particular investment shared by partners, one, we debit the partners capital account at an amount of 50,000, then we credit to account the investment account with an amount of 44,800. That's what you have said there. And then with the gain, which is the revaluation gain of 52, this would be credited in the account called what? The realization account. The realization what? Account. So therefore, the entries which we need to make here is what is affecting realization. So 5,200, we can refer to that as the revaluation gain on investment, which is a figure of 52. So we are not required to prepare the investment account, and then the other entry which we need to make is to debit the partner's capital account with an amount of how much? 50. Remember, we are told that that particular investment will be shared among partners using their profit and loss sharing ratio. The profit and loss sharing ratio we know is 2/5, 2/5, and 1/5. So therefore, we debit this particular account with the investment which was taken over by partners. And basically we take 2/5 times what? 50,000 for Chada and Pete. So this will be 10, and that will give us 20,000. And then for Kidore automatically will be what? Will be 10. So that is now how we account for those particular assets which are taken over by partners. We said debit the partner's capital account, credit the specific asset account. So then below investment, we go back to the trial balance. Below investment, we have goodwill, and equally there is some information we have in note number 2 regarding goodwill, whereby we are told goodwill was considered valueless and was therefore written off. Equally, we say that those particular assets which are not taken over by the new company but they are written off, we credit the specific asset account and then we debit the partner's capital account, equally using the profit and loss sharing ratio. So take into account goodwill was written off, that one will be debited in this account and then credited in a specific asset account using the partner's profit and loss sharing ratio. So the profit and loss sharing ratio for Chada and Pete we know is 2/5. 2/5 times the value of goodwill. So in this case, the goodwill had a value of how much? 26,000. So this will give us what? Let's compute that. We have 26,000 divided by 5. So this will give us 52 times 2. So which will give us 10,400. 10,400 for Chada and Pete, and then 5,200 for the other partner. So with that particular goodwill, then from there we have two other assets there. We have inventories at the end of there and account receivables. If you go to note number 2, we are told inventories and also account receivables. These are the other assets which were taken over by the new company. Any asset taken over by the new company, the books of account of the partnership, or when crossing off the books of account of the partnership, you debit such asset in this account at the book value. The book value is the value in the trial balance. So we have inventories. The book value, the value in the trial balance is 31,200, and then we have account receivables. Account receivables with a book value of what? With a book value of 25,400. So we are through with those two current assets, and then from there we have bank overdraft, accrued expenses, including account payable. There is some information we are given still in note number 2, where we are given the terms of conversion, where we are told all current liabilities were transferred to the new company at the book value. At the book what? Value. And actually those three items, account payable, bank overdraft, accrued expenses, all those are current items of current liability. So those three items of current liabilities were transferred to the new company. So we said in crossing of the books of account of the partnership, those particular liabilities which are transferred to the new company, what we do is that we credit them in this account, in the realization account at the book value. So we have three current liabilities there. Account payables, the book value for that is 62 400. We also have bank OD, bank overdraft. The book value for that is 17,550. And then we have accrued expenses having a book value of 4,000. Having a book value of what? 4,000. So those are the three current liabilities which were taken over. And then from there we go to the other item, which is the partner's capital account. The partner's capital account is crossed off to this particular account. And you can see the partner's capital account in the trial balance is having a what? A credit balance. So therefore that is the first, or basically that one we cross it off in this account and we record it on the credit side. The capital account balance for the first partner is 58,500. For Pete, that is 7,000. And then for the other partner, who is Kidore, is an amount of 500. So we are done with that. And then from there, we have now the profit for the year. The profit for the year, we don't record it in either of these particular accounts, but what we account for is these appropriations, this particular amount which has been distributed to partners, because you can see this profit for the year was distributed among partners. That's what we account for. And all these items here, all these appropriations, they are recorded in this account, the partner's capital account. Anything which a partner is entitled to, including commission, including salary, including a share of profit, including interest on capital, all those items in this account, we do what? We credit them. So let's start with the commission.
Welcome to Manifested Publishers.
Our esteemed learner, welcome once more to our discussions. Still in topic number 2, the forward markets and contracts, we have been able to see that and understand that the type of forward contract depends on the type of underlying instrument or the assets. So we said that there are predominantly 4 underlying assets that are used in derivative: the stocks, the bonds, the exchange rates, and the interest rates. From there on, we have been able to derive the various types of forward contract based on the underlying. And also there is another category, 5 category, which we call others, either the weather, the climate, or even the commodities. So in our previous learnings also, we have been able to see that the stocks or equity drive what we call the equity forward contracts based on 3 categories: the individual stocks. The second category is also the stock portfolios and also the stock indices. On bonds, now we have the bonds and also the bond portfolios and also the forward currency contracts. Our lesson today, we will try and see and understand the category on bonds and also the category on the forward currency contract. So let us see the bonds and bond portfolio, forward contracts, on bonds, and bond portfolios, So we start by reminding ourselves again, we covered it elsewhere, that bonds are agreement or commitment between the issuer, who is the borrower, to pay to the investor, who is the bondholder, the principal sum, the principal sum, we call it the par value, and interest on agreed timelines. So that is the bond, refreshing our minds on bonds, that the agreement between the borrower to pay the investor, the bondholder, the principal, value, par value and interest on timely agreed basis. Therefore, as far as now the forward contracts are concerned, we say that The bonds and stocks are similar. The forward contract of bond and forward contracts on bond and stock on bond and stocks are similar. They operate in a similar way in that they vary or they drive the value from the underlying. We can see this because they have underlying cash flows. They have underlying cash flows. In that now the bonds pay interest. Bonds pay this, they pay interest or coupon, yeah, every 6 months, for example, right? And also equity, they pay what? Dividends. They pay dividends. However, there are differences, isn't it? There are differences from bonds. There are differences. Or differences of forward contract of bonds, forward contract on bonds and equity. One difference is that a bond matures. So one difference is that a bond has maturity. Bond has maturity. Maybe a bond will go for a period of 1 year. Yeah, a bond will go for a period of 2 years or 5 years. So it has maturity. But you find that equity is on perpetuity. Equity is perpetuity. Perpetuity. So unless the company is winding up, the common stock of the equity of the company will outstand unless maybe the company is being wound up. So therefore, the forward contract on the bond must mature. The forward contract of the bond must mature before the bond's maturity. Forward contract on bond must mature before maturity of the bond. Mature before bond's maturity. The second difference that we get is that the special features, bonds have special features. Special features, yeah. These special features included in the bond contract could be what we call embedded options. The embedded options. Now, embedded options, there are additional contracts that can be included in the bond contract. For example, we could have the call option. So this entitles the issuer to pay back, yeah, to pay back the issue before maturity. Before maturity. So what happens with a call option is that the issuer, who is the borrower, in the cases of declining market interest rates, isn't it? Assuming that he had borrowed a bond at maybe a prevailing market rate of 16%, but now the market rate declined to maybe 12%. Now, when that bond indenture, we normally call it the contract, as an option of call option, now the issuer, yeah, the borrower, can retire the bond, yeah, before its maturity, because it can be able to re-enter the market and borrow at maybe 12%, that is the decline rate, and save on high cost of borrowing. Now, there is also conversion. Conversion, we find that the bonds can be converted from a bond, which is a debt instrument, to equity, depending on what favors the bond holder. So the contract, the bond contract, called the bond indenture, can have a provision, yeah, among that contract that grants the right to the bondholder to convert this bond into equity. And we find that this conversion is to convert into equity of the issuer. Equity of issuer. So therefore, with those special features, mostly the embedded options, then the bond forward contract and equity forward contract will differ. The third is that the third difference between the forward contract on bonds and forward contract on equity is that bonds can default. Bonds can default. Bonds can default. What we find that is that the contract, the bond contract, must able to have a distinction. So within the bond contract, we should be able to define what default is. Define what default is. Because we said that forward contract, these forward contracts are customized. So agreement in the meaning of default may change from one party to the other. So within the bond forward contract, they must be able to define what default is and how that default affects the parties. How default affects the parties. The forward contract on bonds and forward contract on equity. So forward contracts, so we can also see that the forward contract on bonds can also be on individual bonds, and they can also be forward contract on bond indices. Bond indices. So this is so similar in the way we found that the equity forward contract can be on individual stocks and also stock indices. Bonds for forward contract are how do we then proceed having that understanding for bonds on forward contract? So the forward contract on bonds, forward contract on bonds. The forward contract on bonds, we must make these assumptions. And the first assumption is that they are mostly, in most time, based on the default-free zero coupon. They are based on default-free zero coupon treasury bills. Treasury bills, commonly abbreviated as the T-bills. The T-bills. So we normally do our discussion on forward contract on bonds based on the default-free zero coupon treasury bills. So this one, they serve as a proxy. They serve as a proxy of the risk-free rate, of the risk-free rate. So we say that at least with the word risk-free rate, we are trying to minimize on the extended effect of default. So that's why in our analysis, as far as we are looking on the forward contract on bonds, we fall for the T-bills. Now, let us look and what happens to these T-bills. Let's analyze them further, the T-bills. Now, the treasury bills, we find that they are sold at a discount from par, sold at a discount from par. What do we mean when we say that bonds then are sold at a discount from par? What we normally say is that price is quoted at a discount rate. Price is quoted at a discount rate. What do we mean price is quoted at this discount rate? To get this understanding, let's have an example. For example, let's say we have a discount rate. Let's say we have a discount rate of, say, 4%. And we know that rates are, in finance, we have had the understanding that rates are quoted annually. So this is 4% per annum. This is 4% per annum. Let's say, for example, a 4% for Kenya shillings 100 per Kenya shillings 100 per that matures maybe in 6 months. That matures maybe in 6 months. Then how will we determine the price? How will we determine the price? So we determine the price using what we call the discount interest. Using the discount interest. Using the discount interest. Now, how do we proceed using the discount interest? Now, normally we said that T-bills are issued at a discount, and at maturity, the par value is paid. For example, if you had a T-bill of 98, yeah, maybe for 6 months, you will find that at 98 is the price that you give the government. You wait for 6 months, and the government pays you back at 100 par value. So these two prices means that the security price was still trading at a discount less than the par value of 100. So normally now what we do in determining this price at 4% and Kenya shilling 6 per 6 months, the price will be determined by the par value of 100, the par value of 100 minus now two things. First of all, 4%, yeah, which is equals to 0.04. 4% is equal to 0.04. Now, rates are quoted annually, and in 6 months, we say those are half an year of 180 days over 360 days, the number of days available in an year, maybe times now the par of 100, times now the par of 100. So you will find out that this will be is equals to 100 minus 0.04 times 180 divided by 360 times 100. This gives me 2. So this is minus 2 to give me a price of 98 for 6 months, 98. Yeah. So this will be the price the instrument will sell. It will sell for 98, such that when it matures, the issuer, yeah, issuer pays 100. So we say in T-bills, they are normally quoted at a discount interest or at a discount rate and not the price. So we are saying that T-bills, these treasury bills, will be quoted at a discount rate, and not the price, and not the price. We also find that the understood discount rate can be computed into the price. We find that the market participant, when they get the discount rate, it can be computed for the price. Using this formula we have used of the discount interest. Having that understanding, then it is our time now to look at the exchange rates. Now, exchange rate, we've said that it is a price of one currency, one country's currency against the price of the other country's currency. So here we say that currency forward contracts, what are they? Currency forward contracts. Now, in currency forward contract, we said that they are normally used by banks and corporations to manage, normally used by banks and corporations to manage foreign exchange rate risk. Exchange rate risk. Let's see this through an example. Let's say, for example, we have a Kenyan flower farmer, a Kenyan flower farmer farm, flower farming farm that has exported into the European market, has exported into European market, let's say euro 12 million. Let's say euro 12 million. And it is expected to receive this payment in 3 months' time. 3 months' time. It's expected to receive this payment into 3 months' time. So what happens at 3 months' time? This farm, because it is Kenyan by operation, it will receive euros. It will receive euros, okay, and convert them into Kenya shillings and convert into Kenya shillings. So the Kenyan farm will be selling euros and the Kenyan farm will be buying the Kenya shillings. That is what we are saying. So in order to manage against the exchange rate risk, and the risk here can come from volatility. And in volatility is the probability or the chance that the exchange rate between the Kenyan shilling and the euro could keep on fluctuating, isn't it? So they approach a dealer. Let's say they approach one dealer called Absa Bank. Yeah, and Absa Bank is able to agree to quote, an exchange rate maybe of Kenya shillings 125 per 1 euro. Yeah, so it will be able to quote that, and this will remain in force for the next 3 months. So this quote now is static, right? Therefore, the Kenyan farm now has at least gotten an assurity that in 3 months' time, it will be able to sell the Kenya shillings at the rate of 125 for 1 euro. Now, what happens at 3 months' time? Now, our farm will be able to, in 3 months, will approach Absa, and convert euro 12 million into Kenya shillings. So if the exchange rate at 3 months has been set at Kenya shillings 125 for every 1 euro, what about 12 million euros? What about 12 million euros? So we cross multiply to give me 125 times 12 million euros to give me 1.5 billion. So the farm will be able to obtain Kenya shillings 1.5 billion. If you like, 1, 5, 1, 2, 3. Yeah. So therefore, locking in the exchange rate at 125, and therefore the farm will not be exposed to the risk of fluctuations of the currency. Having seen the similarities between equity forward contract and the differences, or to also bond forward contract, we also found out the bonds and the bond portfolios, how they trade, and the forward currency contracts, and how they can be helpful in managing the foreign exchange rate risk. We have come to the end of the lesson, of which now we must be able to give an assignment so as to see the progress of our learning. So as an assignment, assignment number one is discuss the various differences of forward contract on bonds, contract on bonds, and forward contract on equity, forward contract on equities. Number two, assignment number two, determine the price for a treasury note, for a treasury bill quoted at a discount rate of 4.2%, quoted at a discount rate of 4.2%, that matures in 90 days, given 360 days in a year, 360 days in a year. So for a lesson, the assignments, they are two in number. The first being discuss the various differences of forward contract on bonds and forward contract on equities. Number two, determine the price for a treasury bill quoted at a discount rate of 4.2% that matures in 90 days, given 360 days in a year. Thank you for your participation.
Welcome to Manifested Publishers.
My dear Lana, thank you for attending this session. And we are still under the derivatives analysis. And our major topic is the introduction to derivatives. And basically, in our previous sessions, we have been able to see what derivatives are and what derivative instrument forms they can take in terms of the type. So for today's session, we are going to look on the overview of derivative markets, the overview of derivatives market, and in that we are interested also to look at how these markets are regulated. So regulation will form part of our discussion today. And who are the players, or the major people who are involved in dealing with these instruments you're calling derivatives. Now, as an overview of derivatives, the overview of the derivatives market, we want to take some brief history about how derivatives came about. So in 1970s, starting from the US and also across the globe, we've seen there is increased effort in deregulation. Deregulation came about with a term we call the market liberalization. There was a concern about
different market participants about letting the free hand of the market, in what we were able to understand in our previous learning lessons in economics, that market liberalization is letting the free hand forces of the market maybe to be able to determine the prices. Now, what this deregulation meant is that the participants now were able to go further and see the development of the futures. Yeah, in our earlier discussion, we said now these features are highly standardized. Yeah, they are available in very different. They are available in standardized format at the listed exchanges, and then we said that these features being customized later we saw the development of options. So after this was set up, and with increasing also aspect of deregulation, we saw that the oncoming or the emergence of customized forwards and swaps. So forwards and swap, we said these are under the forward commitment. Just what people are doing here, the participants are agreeing to do something for the other. They are what we call bilateral agreements. So these are predominantly the bilateral. Bilateral means they are gentleman's agreements. Bilateral. So agreements between two parties. So normally this market of derivatives also saw the interbank, what we call the interbank market. So the interbank market, so a connection of the connection of global banking networks. So normally why some people would prefer to call derivatives as products from the interbank is because now the emergence of derivatives came because of the connection of the various global banking networks now, and whereby now the banking system saw the opportunities, isn't it? So the banks now, here the banks are the participants within the derivatives market who saw the opportunities to offer positions to other corporations or the players involved, so as to eliminate players involved who wanted to eliminate risk. So the bank saw an opportunity, and this opportunity could make profits. Profit from where? The people who wanted to eliminate risks, isn't it? So, however, the question now comes in that banks predominantly are not in the business of getting risk. So what do they do? Now, banks also, they depending on these networks that we've talking about, they have the networks, so they leverage their networks, and also they leverage their vast resources. Now, what they do under that leveraging of the networks and vast resources, they are able to transfer and lay off the risk. They transfer and lay off risk within their systems and vast resources. Therefore, they are able to profit. They are able to, in doing so, they are able to profit from bid ask spreads. So bid ask spread is normally what we would say the buy and the sell differentials of the prices. Now, there is a bid. Yeah, a bid is a price in which a dealer wants to buy, yeah, a particular asset, and an ask is the price in which the dealer wants to sell. If those prices then are different, it presents an opportunity to make a profit. So banks predominantly do not come to the derivative markets to shoulder on risk, but they come to be able to be an intermediary, so that when they're able to identify their networks who may be willing, yeah, to accept, then they can be able then to buy the risk from the party who is not willing, and then sell the risk to the parties who are willing. Now, that that evolution still goes on today, and we find that there are other major category whom we call the derivative dealers. Derivatives dealers. So with the derivative dealers, we said these now, they make the market. These are market makers. What do we mean by market makers? What we mean by that is that they are able to establish positions with the market at their own name, with their own resources, maybe to establish a bid. Yeah, so they are going to buy. So when someone enters the market and there is already existing buyer, yeah, that was never there, so a dealer makes that market. Or they can establish positions in their own name on the ask. So they are sellers, isn't it? So when sellers never used to be there in the market, and the dealer now comes and establishes an ask position, now is able to be called a market maker. Now, we are seeing that these predominantly are the large global, predominantly they are large and global commercial banks and investment banks. Commercial banks and investment banks. So, and the evolution of the derivative market is still occurring, such that you find that now we have electronic trades. Electronic trades, yeah, that occur through e-trading. Yeah, so these occur through the cross networks of computer systems. So the cross networks of computer systems, So you find that players are able to establish their position either to buy or sell the derivative instrument across connected systems. Now, having seen the overview of derivative markets, a brief history, and up to where we are currently on e-trading, then we can ask ourselves, then why should there be regulation of derivatives? Key thing to note is to ask ourselves why, and we say predominantly the regulation of derivative market is to be able to protect the unsophisticated participants. Yeah, of course, through other criticisms that we will find in our coming topics, we will find that derivatives are not that simple. They are criticized for being complex. Therefore, we might get some participants who are not well versed with the terminologies or the happenings or the mechanics of derivatives. Therefore, there is need to have regulation. So we have seen that regulation of derivatives also occurs at the trading. So, and we have seen that trading has evolved. So it has evolved from what we would call as pit trading. Now, in a pit trading system, this generally refers to a face-to-face. So this is a face-to-face trading platform. Trading platform where traders execute trade manually, execute trades manually, yeah. So we have seen this was before, yeah, during the early years, we used to use the pit trading. Now, however, we have seen that evolution has taken place. It has even come to the electronic trades and e-trading. Now, with regulation also, we also find that there are issues to do with customized, yeah, the customized instrument, the customized instruments, for example, the forwards and the swaps. So we have been having the discussion, say, the customized instrument, for instance, forwards and swap are less regulated. Yes, they are less regulated in the derivative instrument themselves, less regulated. That is true. However, there is what we call, they now come to be indirect regulation oversight. Indirect regulatory oversight. So what do we mean by indirect regulatory oversight for less regulated instruments or non-regulated instruments or customized instruments? Now, we are saying that the companies that offering, the companies or banks that offer these products are regulated. Let's say, for example, we have within Kenya, the international bank called ABSA. Now, this bank is subject to the regulation in two fronts. Yeah, it's subject to the regulation by the Securities Exchange, because it is a listed company, predominantly through the Capital Market Authority, the CMA, and also ABSA as a bank is subject to regulation through the banking regulation, regulations through the Central Bank of Kenya, the CBK. Therefore, if ABSA now is dealing with forwards and swap, we must keep in mind that there is some form of indirect regulatory oversight. So, and also we are saying that this customized instrument still are regulated through the normal contract and or civil law. Yeah, so the law of contract applies to them, or if participants have disagreements, they can be able then to approach the courts to have their issues determined. Now, having understood the overview of derivative markets, having understood the regulation, let us look on the players. So with the players, there are predominantly three categories. The first category are the speculators. Now, the second category are what we call the hedgers. And the third category is what we call the arbitragers. Now, we normally categorize them by the motive on why these participants approach, or predominantly why they do come to the derivative market. The speculators, these are the people who analyze, they perform forecasts about future price movements, and would place bets in order to profit. Yeah. So speculators, these are people who make forecasts, isn't it? They try to predict the future movement of prices and be able to place bets. Now, what do I mean by placing bet here? By placing bet is to make an informed choice, yeah, depending on what the models that they have done, and if it turns out to their favor, then they can be able to profit. For example, if a buyer or if a trader speculates that a particular share, let's say a Safaricom share, is going to increase in the next 3 months, he may place a bet, yeah, by either obtaining an option, right, by paying an option premium today, and able to set the price, yeah, and if the movement of price is increasing, then you will enter a call option, yeah. If you focus the increase in the share price of Safaricom, he enters the market to establish a call option, the right to buy. So when the market move, he exercises the move to the direction that he had anticipated, then he exercises the call option and buys, and therefore he is able to re-enter the market again, sell at a higher price than what he had buy to make a gain. That would be a speculator. Now, with hedgers, these are predominantly people who enter the derivative market primarily to protect themselves against risks, and this risk comes because of price movements. Yeah, this could be an example maybe of a portfolio manager who may be holding portfolio of bonds, and we are aware that when the interest rates are increasing in the market, there is also a negative relationship of the price or the value of that portfolio. Therefore, an hedger would like predominantly to protect themselves against that risk. Now, arbitragers are players within the derivative market who establish positions. They establish positions. Establishing position here, we mean either taking a buy or sell position, yeah, in order primarily, or in order to profit from price mispricings, in order to profit from mispricings in the market. For example, let's say there is a dually listed company share of a company, let's say, of Safaricom, and let's assume that it is listed in Uganda shilling. You may find that maybe the price in Kenyan market is around 40 shillings. But when you go to the Uganda market, maybe due to the market forces of demand and supply within the Uganda market, that price share could be selling for 38 shillings. So you may find an arbitrager who may want to buy the share in Ugandan market and maybe do what? Sell the share in the Kenyan market, right? And then exchange that amount of money at a given exchange rate of the Ugandan shilling, obtain Uganda shillings, and be able to buy at a cheaper, at a cheaper price of 38 Uganda shillings, and therefore you find that he is able to profit by 2 shillings per share. Then that the party who enters into a derivative market primarily to establish position in order to profit from the mispricings, then is an arbitrager. Having seen the different players within the derivative market and how they are regulated, then we must look at the trading of derivatives, the trading of derivatives. Primarily, we say that the trading of derivatives has evolved from trading through pits, or what we have said is a pit trading, the face-to-face meeting of the dealers within a physically place to be able maybe to give each other instructions, either buy or sell, isn't it? Now, this has evolved to electronic trading platforms, yeah, and of course this also occurs predominantly through the over-the-counter markets. They can also occur through the over-the-counter, that is OTC markets. And over-the-counter market, as we have been saying, these are the for customized instruments. Then we also have the listed exchanges. For example, the Nairobi Securities Exchange, yeah, and we are aware that recently that the Nairobi Stock Exchange did start the trading of derivatives, and then what predominantly is listed at the exchanges, in most exchanges around the world, then we could have maybe futures, futures, so and we said futures, these are the standardized instruments. They are standardized instruments. And having said that futures predominantly, then we see the commodities futures. So futures will be the derivative instrument, that drive their value from the underlying. Now, the underlying in commodities could be oil, precious metals like gold or diamond, or we could have agricultural commodities like wheat or even what we call corn, or other books could call it maize. Yeah, so those are the underlyings predominantly of commodities features that are traded the listed exchanges. The last aspect to look at is the buying and shorting of financial derivatives. The buying and shorting of financial derivatives. So to establish a buy position, we say you take the long position. Yeah, to buy an instrument, this is called a long position, which means to buy. If someone says short position, the short position, then this means that it is a sell position. Now, that understanding takes us to the end of this session, where we have been able to see the overview of derivatives from the deregulation era and up to the electronic trading era. We have also seen that regulation is very important in that it will be able to protect the sophisticated participants, and also there could be aspect of indirect regulatory oversight where the institutions that trade derivatives are subject to other regulatory oversight. The speculators, hedgers, and arbitrators formed the players within the derivatives market, and then trading of the derivatives between the OTC market, predominantly through electronic trading platforms or listed exchanges, where we see that commodities futures are also traded there. And how do you name a buy and a sell? We name a buy through long position, and we say a sell is as a short position. Now, as our assignment for this session, discuss any three players found in the derivatives market. So for the assignment for this session, you're supposed to discuss any three players that are found in the derivatives market. Thank you. Once more, my esteemed learner, I appreciate the fact that you continue to consume our study session. In this study session, still under topic 3, the futures market and contract, we're going to have a discussion about the pricing of a currency futures contract, a currency futures contract. Now, remember when we were discussing in our previous study session, we said we price the futures contract similar to forward contract for the currency, and we said that the currency futures are based on exchange rates, for which this exchange rate is the price of one country currency against the other. So the intuition here is about owning the domestic currency and the foreign currency, and being able to earn the interest either in the foreign country or in the domestic country. So, however, they are not mostly commonly used, not commonly used, because traders would prefer a very large variety of pairs, country pairs, that the listed exchanges may not be able to provide, Yeah, so that's why now many participants prefer the forward contract. However, we will price the same the way we did currency forward. Will price the same as currency forwards. Now, remember we said the futures price is given by the spot exchange rate, that is discounted by the foreign interest rate, over there, and then this is compounded at the domestic interest rate, Then how then can we be able to see this in terms of the formulas now? Now, this one we start with the discrete. So in the discrete, what you have said, the futures price now will have to the spot exchange rate, so discounted at 1 plus. Now, we will use R superscript F, superscript, that is raised to power F like that. Then this compounded at T there so that you can be able to discount. Then all this is compounded at the domestic interest rate. So 1 plus R. Now our R without anything, is domestic interest rate and T over there. So for continuously compounded, interest rate framework, now my FP the same, so it will be my SOE, now discounting at the foreign rate, continuously compounded power T there, multiplied by now the R, which is continuously compounded over T, like that. So for us to be able to understand this further, it is prudent that we see it through an example. Pricing the currency futures. The spot exchange rate for the Swiss franc is US dollar 0.60. The US interest rate is 6% and the Swiss interest rate is 5%. A futures contract expires in 78 days. Assuming the trader is domiciled in the US market, required: A, find the appropriate futures price. B, find the appropriate futures price under the assumption of continuous compounding. And C, using part A, execute the arbitrage resulting from a futures price of 0.60. 0.62 US dollars. So our example, pricing of currency futures, example, pricing of currency futures. So this one over there, now we need to define our terms here. So our A is 78 days, or sorry, in part A, sorry, our time is 78 over 365. And also our SO, the current exchange rate, is 0.60. Then we also need to define our foreign rate. Our foreign rate is 5%, which is 0.05, and our now domestic rate R is 6%, which is equivalent to 0.06 over there. So using the discrete formula, so my FP here is, then my SO is 0.60. Then I'm supposed to discount it by the foreign interest rate. So 1.05 there. My time is 78 over 365 days. All that I should be able to multiply it 1.06 and 78 over 365. So this will be 0.6 divided by into bracket 1.05 raised to power, this the bracket 78 divided by 365, close the two bracket. So this is 0.59377,66665 times 1.06 raised to power 78 divided by 365. So times 1.012529835, then answer times 0.59377,6665. So 0.6012. That is rounded into 4 decimal places for accuracy. Then part B now requires us to be able to see the same through the continuously compounded interest rate framework. So continuously compounded. So for us to be able to proceed, we should be using the continuously compounded rate, for which we say if we are to convert a rate that is discrete to continuously compounded format, we said the formula we use is R continuously is equals to ln 1 plus R. So, and we know our foreign continuously compounded interest rate will be the ln 1 plus the foreign rate is 0.5, and then for the domestic rate the same ln 1.06 over there. So my ln 1.05 is what? 0.04879, like that. 1, 2, 3, 4, 5 decimal places. Then my ln 1.06 gives me 0.0582
2, 7, like that. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yeah, 5 decimal places. And this now will be able to apply the continuously compounded formula there to get our futures price is equals to my SO is still 0.60, and it is now E minus the 0.04879, then times the 78 over 365. Then all these into E, then my 0.05827 times the 78 over 365. So my answer should be, so 0.60 shifts E, sorry, 0.60 shift E into bracket minus 0.04879 times 78 divided by 365, close the bracket. So I'm getting 0.59376685 times my E shifts E into bracket 0.05827 times 78 divided by 365 to give me 1.012530071. So answer times 0.59376685 to give me 0.6012, like that, rounded into 4 decimal places. Now, that is our requirement, which we find gives us the same answer. Then part C is asking us to be able to determine what arbitrage opportunities exist. So you find that now a price of the futures contract at 0.62 is overpriced. We make that determination. And in our prior finance learning, we saw that an overpriced asset should be what? Should be sold. Should be sold. So sell the futures contract. We sell the futures. So we are going to sell the futures like that. So, however, to be able to sell that futures, we should be able also to determine the number of currencies that we like today. So, for 1 unit, of US dollars, how much do we need now? How many do we need now? So if you are to receive 1 unit of US dollar, yeah, at maturity, how many do we need now? We should be able to use the foreign interest rate to discount, isn't it? So we have 1 using the foreign interest rate to discount, 1.05 into 78 over 365. So 1 divided by 1.05 raised to power 78 divided by 365, close the bracket. So 1 divided by 1.05 raised to power, open the bracket, 78 divided by 365, close the 2 brackets. So this gives me 0.989
0.628. So that is the unit of US dollar you require today. So we discount it at the foreign interest rate. That's what we've done. We require this. However, should be compounded. Yeah. So they will grow. So this one, the $1 US dollar will grow to a future value of 1 unit, 0 unit in future. Okay. So what is then the return? So we should be able to compute the return. Compute the return. So the return we know is our ending value over beginning value. Ending value over beginning value, which is equal to 0.62 over 0. We began with an investment of 0.9628 multiplied by the spot exchange rate at the beginning times 0.60. So that is what we began with. So this now gives me 0.62 divided by into bracket 0.98628 times 0.6, which gives me an ending value of 1.0477 1. So this answer minus 1 gives me a return of minus 1, gives me a return of 4.77%. 4.77%. So this is the return that is, sorry, for us to be able to compute the return, this is not how we do it, because the number of years has not been standard. So it's not for 1 year, it's for 78 days over 365. So we will need this answer that we got there, 1.0477, and then we annualize for you to guess the return. We annualize, and we said we annualize by saying 1.0477 now by 365 over 78, all these minus 1. So 1.0477, close the bracket, raised to power, open the bracket, 365 divided by 78, close the bracket, then minus 1. This is a return of approximately 24.37. So an approximate percentage return of 24.37, which is higher than the risk-free rate and therefore preferable. So that, my dear learner, having understood how we price the interest rate futures contracts, the pricing of the currency futures contract, now using the discrete and continuously compounded framework, and if you are able to observe the market and be able to go to utilize an arbitrage opportunity and compute the return therefrom, this takes us to the end of our study session. Now, as has been our tradition, then it's time to do an assignment, of course, without referencing to the study session material. You are required from the assignment that says the spot exchange rate for the British pound is US dollar 1.4390. The US interest rate is 6.3% and the British interest rate is 5.8%. A futures contract on the exchange rate for the British pound expires in 100 days. Required: A, find the appropriate futures price. B, find the appropriate futures price under the assumption of continuous compounding. Requirement part C: suppose the actual futures price is US dollar 1.4650. Is this future contract mispriced? If yes, how could an arbitrator take the advantage of the mispricing? Use a discrete compounding as in part A. Thank you for your participation.
This is what the question says. Peter Chawawa started a retail business on 1st January 2012. He has not been filing income tax returns for the 6 years to 31st December 2017. Now, an investigation of his affairs revealed the following. 1. The balance sheet of the retail business as at 31st December 2012 was as shown below. So we have the fixed fixed assets, which consists of premises 2,000, furniture and fittings 1,000, motor vehicle 500, current assets given, debtors, bank balance, cash in hand. Then total assets. We have the capital as at January 2012, net profit for the year, drawings, mortgage loan, creditors. Number 2, he constructed an extension to the premises in the year 2016 at the cost of 625,000. The following accounts balances were outstanding in the respective years as shown below. So we have the trade debtors, bank balance, trade creditors, cash in hand, stock. He withdrew goods worth 5,000 per month per annum from the business for his personal use. The principal repayment on each mortgage loan amounted to 250,000 per annum from 31st December 2013. The mortgage interest paid in each of the 4 years ending that 1st December 2013, 14, 15, and 16 amounted to 100,000, 75,000, 50,000, and 25,000 respectively. His wife opened a saving account in a commercial bank in the year 2012. The balance in the account after crediting the interest earned were as follows. 2013 all the way to 2017, we have the saving account interest earned. Then his living expenses and wear and tear allowance were agreed with the Revenue Authority as follows. So we have the living expense, the wear and tear. So we are required to compute annual income of Peter Chawawa from 2013 to 2017. So here again we see that we have been given several assets and several liabilities, and we are required to get the taxable income. So the first thing that we normally take, we note which years are we getting the taxable income. It is from the year 2013 to the year 2017. So now we have to determine if you are given the capital by the beginning of 2013. Yes, it is given in additional information number 1, because we are given the balance sheet as at 31st December 2012, which obvious the balance sheet has the capital, the assets and liability. So if you look at the capital, we cannot talk of 3,000 because that is capital as at January 2012. So we want at the end, which was now that at the beginning capital, net profit for the year less drawings, you get 2,800. That is the capital now at the end of 2012, which marked the beginning of 2013. When the time comes to use it, we'll use it. So the rest we have to now, since we are not given the capitals for each of the year, take the assets minus liabilities. But if you look at the ones that are for each of the year, they are in point number 3, that the following accounts balances were outstanding in the respective years as shown below. So where we have trade debtors, the bank balance, creditors, cash in hand, and stock. But if you look at the characteristics of those assets and liability, they are current one. We don't have fixed assets and fixed non-current liability. So we have to confirm if we had them. Yes, we had them. If you look at the balance sheet of December 2012, there are fixed assets, 3 of them. Those must be carried in the subsequent years automatically. And when it comes to the premise, as per additional information number 2, we have an addition in 2016. So we just add. Otherwise, the others will be the same for those years. When it comes to the non-current liability, we can only find one. the mortgage loan of 1,000 as at 31st December 2012. So that should be in the subsequent years, except that in additional information number 5, we are told that the principal repayment on each mortgage loan amounted to 250,000 from 31st December 2013. So it was being paid 250 every year. So we'll be reducing by 250 every year. Otherwise, we post them as they are. So we'll have Peter Chawawa, capital statement. So we have the years that we are required to get: 2013, 2014, 2015, 2016, and 2017. As per the required in the computation of taxable income. And I want us to convert them to shillings thousand. We start with total assets. So first of all, we'll bring forward the non-current assets, which we have premises, 2,000, 2,000, 2,000. But now in additional information number 2, there was an extension in 2016 of 625. It will be 2625, 2625. And then now the other fixed assets, furniture and fitting, $1,000. Then motor vehicle, $500. Then we now bring forward the point number 3, trade debtors, $173, 190, 208, 230.5, 253. Bank balance, which we have 109, 194, 281, 281. Now for the last year is an overdraft, so we put a dash. We have cash in hand, $10. Stock, $255, 302.5, 332.5, 366, 402.5. Now there's still another asset in point number 6. His wife opened a saving account in commercial bank in 2012. The balance in this account after crediting the interest earned was as follows. Although they are the wife, it is the wife the account, but we are not told that it was a separate or she was not getting money from the business. Because that is not clear, we have to assume she was getting money from the business being given by the husband. So it should be considered here. Remember we said we consider all assets, both commercial and private. So you'd have saving account, 300, 900, 100, 725, and 750. With no other, we will get the total. And then we come to the total liabilities. So we start with the non-current liability in the balance sheet on number 1 as at 31st December 2012. We have mortgage loan. So in additional information number 5, we were told that there was a payment of 250 every year. So here 1,000 minus 250 give us 750. Minus 250 again, 500. Minus 250, 250, minus 250, dash. And then now we bring the current liability. In point 3, first we have the bank overdraft. A negative bank account represents a bank overdraft. So which was in the last year here, 32. And then the other one is the creditors, trade creditors. Trade creditors which you have to 30, 241, 253, 272, and 291.5. And then we can get the total. So 2,000 plus 1,000 plus 500 plus 173 plus 109 plus 10 plus 255. 255 plus 300, giving us 43, 47. We do the next one, 2,000 plus 1,000 plus 500 plus 190 plus 194 plus 10 plus 302.5 plus 900. 5096.5. The other one is 2,000 plus 1,000 plus 500 plus 208 plus 281 plus 10 plus 332.5 plus 100. Half 44, that 1.5. The other one is 2625 plus 1,500. This is already 1,500 plus 230.5 plus 281 plus 10 plus 366 plus 725, giving us 5737.5. Next is 2625 plus 1,500, that is the 1,500 plus 253 plus 10 plus 402.5 plus 750. 5540.5. The other one will be 750 plus 230. 980 Then this will be 741. This will be 503, 272. And then this one is 291.5 plus 32, giving us 323.5. Now we can get the capital at end of the year. That is assets minus liabilities. So it will be 43, 47 plus 980 plus 980 minus, sorry, it should be minus 980, giving us 3367. Next is 50, 96.5 minus 741, give us 4355.5. The other one is 44, 31.5, and then minus 543, 3928.5. The other one is 57, 37.5 minus 272, giving us 5465. 5465, 65.5. Then 5540.5 minus 323.5, giving us 5217. Then now we less capital at the start of the year. Which for the first year we have to bring the capital that was there, which was 2800. The one in additional information number 1. Now for this one it will be this one, 3367. This one will be 4355.5. This one comes here, 3928.5. And this one 5465.5. So we'll get the net accounting profit. So we start with this, that figure minus 5465.5, giving us negative 248.5. This one 5465.5 minus 3928.5, 1537. The next one is 3928.5 minus 4355.5, 43. $43.55 $43.55.5, giving us negative 427. The next one, this one, 43.55.5 minus 33.67, $988.5, 33.67 minus 2800, 567. Now this will now add non-allowable expenses as per the question. Number 1 does not have an expense. Additional information. Number 1 was a balance sheet. Number 2 was an extension. Number 3 were assets and liability. Number 4, he withdrew goods worth 5,000 per annum from the business for personal use. So we have drawings. Drawings are not allowable expense, which we are told each year was 5,000. Since they are shillings 1,000, it will be 555. Number 5, the principal repayment on each mortgage loan was 250 per annum from 31st December 2017. That doesn't have any issue. It's not an expense. It's a loan that was being repaid. But there was mortgage interest. Mortgage is used to construct a residential house. So the interest on mortgage is not allowable because it's not for business, it's for residential. So mortgage interest which we are told it's 100, 75, 50, 25. This didn't have anything. The number 6 is about the saving account and interest earned. That's an income, not an expense. Number 7, there is living expense. Living expense are not allowable. $300, 400, 450, 500, and 600. And wear and tear, that's now, wear and tear, remember, is a capital allowance. Capital allowance. So an unallowable ends there. We now less capital allowance and non-taxable incomes. And we start with capital allowance. We said capital allowance is the wear and tear. So capital allowance or WTA. So we deduct, we have 155.5. We have 130. We have 109. And then 73, 157. The only thing that remains is the non-taxable income. So we continue here, 2013, 2014, 2015, 2016, 2017. So we now look for the non-taxable income. There was only one income in the question. In number 6, interest earned from saving account. That, if you look at what we said when we were looking at the taxation of the business income, interest earned by an individual from a bank is a qualifying interest. Withholding tax is final. So that we need to remove because we should not be taxing it again. So interests from bank saving account, which we have 300, 900, 100, we have 725, and we have 750. Sorry, the interest are 25. These are saving account. We are looking at the interest 75, 90, 70, 60, and 60. Now with nothing more, we can get net taxable incomes. So we add them. So we'll start from here, 567 plus 105. This actually 405. plus 405 minus 155.5 and then minus 25. 791.5. Next, 988.5. And then this is 80, 480 plus 480 minus 130 minus 75. 1263.5. Next, negative 425.7. 427. And then this 500, 505 plus 505 minus 109 minus 90. Negative 121. Next is 1537. This 525, 530, so plus 530 minus 73 and also minus 70. It will be 1924. Next, negative 248.5. That is negative 248.5 plus 605 minus 157 minus 60. We have 139.5. Yeah, so that is how you determine the taxable income using the capital statement under the tax investigation. So that brings us to the end of this topic. Until I see you in our next the next lesson, see you then. Have good time. Thank you. Hi there, my name is Patrick Kamau Kamure, and I welcome you today to our lesson where we continue looking at the tax planning. You can see it's a continuation from our previous lesson where we started looking at the tax planning for the individuals and especially those in employment. And by the end of that lesson, after looking at various opportunities available to a person under the employment, we say that this lesson we are going to look at a question. So I'll read the question, then we see how we can solve the question. So here I read. Peter Samoei is an employee of Zawadi Limited and earns a salary of 140,000 per month, while his wife Sabina Wanga works in Lindi Limited, a firm in which Mr. Samoei controlled 18% of the share capital. Her salary is shilling 60,000 per month. Sabina Wanga owned the house which is occupied by the family, for which the market rental value is shillings 45,000 per month. The house was constructed in the year 2017 at a cost of 6 million, borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance premium of 4,800 per month and city county rates of 6,900 per annum. Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda but operating in Kenya. Zawadi Limited paid school fees of 80,000 for the couple's children, which was expensed in the firm's income statement. Required, suggests 4 tax planning scheme that could minimize the tax liability of the family. So we are supposed to suggest 4 tax planning scheme that the family can use to legally reduce the tax they are supposed to pay, because that is what tax planning is about. So if you look at the question, let's go item by item. We spot an opportunity, then we indicate how it can be utilized. Peter Samoei is an employee of Zawadi Limited, earning a salary of 140,000 per month. There is no opportunity there. While his wife, Sabina Wanga, works in Lindi Limited, a firm in which Samoei control 18% of the share capital. There we have an opportunity. We said if the wife work in a company where the husband control 12.5% or more of the shares, the wife income is added to the husband income to be taxed together. But when it is less than 12.5%, it will be taxed separately, and in which case both of them would claim personal relief, and also the wife income would be taxed at graduated scale rates. So we put that down. So we had reached up to the second sentence. Now we continue. Her salary, now the wife, is 60,000 per month. Sabina Wanga owns a house which is occupied by the family, for which the market rental value is 45,000 per month. The house was constructed in the year 2017 at the cost of 6 million borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance of 4,800 per month and county rates of 6,900 per annum. So there is another opportunity from that point of the wife owning a house which she constructed through a SACCO loan. Now, in this case, remember, SACCO loan do not qualify for mortgage interest relief. Remember, we say that an opportunity available to an employed person is to use the mortgage interest relief to reduce the taxable income and eventually the tax to be paid. So what should she do because it's not a mortgage? She should take a mortgage loan and use it to pay the SACCO loan. And now she will remain with the mortgage loan, in which case now she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. And we are going to show the amount, which we said is the lower of interest on the loan and the 25,000 per month or 300,000 per annum, whichever is lower. So what we are saying is that the wife, Sabina Wanga, should take a mortgage loan and use it to pay the SACCO loan so that she can qualify for mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. With the lower of 12% per annum of the mortgage, that is now the interest, which is 720 for the whole year, and the limit, which is 25,000 per month times 12 for the whole year, 300,000. In which case we get the lower to be 300,000. Now we continue. The second paragraph, Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda, but operating in Kenya. So there is another opportunity, family insurance cover, that is life insurance cover. So if it is outside Kenya, a company outside Kenya, one cannot qualify for the insurance relief. So he should shift it to a Kenyan company so that now he can be able to claim the insurance relief to be used to reduce the tax payable. With the ROA of 15% of the premium he is paying, and we compare with 5,000 per month or 60,000 per annum, whichever is ROA. So number 3. So that's what we are saying. Mr. Samoei should transfer the family insurance cover from a company incorporated in Uganda to a company incorporated in Kenya so that he can claim insurance, insurance relief to be used to reduce tax payable with the lower of the interest, 15% of the premium, of which case, since we are not told whether it's per month or per year, we assume it's per month so that we multiply by 12 to get for the whole year. And we compare with the limit, which is 5,000 times 12, 60,000 per year. The rest is that one. So we look at the last part of the question. The last part which we are told, Zawadi Limited paid school fees of shillings 80,000 for the couple's children, which was expense in the firm's income statement. Now, we had said that if the company expends the school fees in the income statement, it is a taxable benefit on the employee. And since now we are advising the employee how he can reduce the tax liability, is we advise him to request the company not to expense the school fees in the income statement so that it will become a tax exempt benefit on him. So number 4. So if you look at the required, we were supposed to suggest 4 schemes, and the 4 schemes we have provided. So that is how you are supposed to answer that question. That is one question. I'd like us to look at another question to see how we can answer it. This is what the question says. Albert Kimeri is an employee of Ruaka Limited. He has provided the following information relating to his income. Number 1, he earned basic salary of shilling 60,000 per month. He is paid house rent allowance of shillings 30,000 per month. His wife Ravena Kimeri is employed at a salary of 54,000 per month with Tops Limited, where Kimeri hold 20% of the shares. Now, number 4, they both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. The employer paid school fees for the children of Albert Kimeri. He was a member of an unregistered pension scheme where the employer made contribution towards the scheme on his behalf. The wife ran a farming business where she earned 400,000 from the sale of farm produce. He is contemplating securing a bank loan for his children, education, or an education insurance policy that will equally cater for their children's education. We are required to suggest a tax planning that will minimize the tax liability of the family of Mr. and Mrs. Kimeri for the year of income and the subsequent years. So in this case, we go through the question one by one, analyzing for any available opportunity. We start with number 1. He earned a salary of 60,000 per month. There is no benefit or opportunity that can be utilized there. Number 2, he is paid house rent allowance of 30,000 per month. Again, there is no opportunity that can be utilized there. His wife, Ravena Kimeri, is also employed at a salary of 54,000 per month with Tops, where Kimeri holds 20% shares. Like we said in our previous question, reducing the shareholding to less than 12.5% so that the wife is tax separated from the husband, so that both can enjoy 2% relief and the wife income can be taxed at graduated scale rate. So solution. So what we are saying is that Albert Kimeri should reduce shareholding at Tops Limited, where the wife worked to less than 12.5% from 20%, so that they are tax separatory in order to enjoy 2% relief and for the wife income to be taxed at graduated scale rates. So we were in point number 3. So we now go to point number 4. They both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. Now, we are not told that the borrowed funds is mortgage loan. So, borrowed funds does not mean mortgage loan. So, we should advise, like the other one, that the wife should take a mortgage loan and pay the borrowed funds so that she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax to be paid. So, number 2. Now, since we haven't been told how much the fund was, we just state, yeah? So, the wife Ravena Kimeri should take a mortgage loan and use it to pay the borrowed funds in order to qualify for mortgage interest relief, to be used to reduce taxable income with the lower of mortgage interests and also 25,000 per month or 300, whichever is lower, to be used. We continue. That was point number 4. We go to point number 5. The employer paid school fees for the children of Albert Kimeri. There is another opportunity there that Kimeri should request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him. So number 3. So Albert Kimeri should request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him so that he's not charged tax. So that was point number 5. We go to number 6. He was a member of unregistered pension scheme where the employer made contribution towards the scheme on his behalf. Now, there's another opportunity there. Employer contributing to an registered pension scheme, it will become a taxable benefit on him. So he should join a registered pension scheme so that when the employer contributes for him, it will become a tax-exempt benefit. So we put it down. So Albert should join a registered pension scheme so that when employer contribute for him, it will become a tax-exempt benefit. As at the stand now, it is a taxable because it's unregistered. We continue. Number 7, the wife runs a farming business where she earns 400,000 from the sale of farm produce. For that one, there is no benefit one can derive out of that. So that one we ignore. 8, he is contemplating securing a bank loan for his children education or education insurance policy that will equally cater for the children's education. So the best opportunity is to take an education insurance policy so that he can claim the insurance relief to be used to reduce the actual tax payable instead of a loan. And we say that with the lower of 15% of the premium or 5,000 per month or 60,000 per annum, whichever is lower. So we are saying that Albert should take an education insurance cover instead of a loan for the children education so that he can claim insurance relief to be used to reduce tax payable with the lower of the 15% of the premiums or 5,000 per month or 60,000 per annum, whichever is lower. So that one, or that's how you answer the question involving the tax planning for the individuals. So there are some questions that you are going to do given after this video, so you can use them and test yourself. For today, we are going to stop there until I see you in the next lesson, where we look at the tax planning for the limited company. Thank you very much.
Hello learners, and welcome to the Business Data Analytics session. I am your illustrator, Nicholas Sikali. Today, we are going to tackle a question on the statement of cash flows and see how we can be able to solve a question on the statement of cash flows using Excel. The question that we are going to use is the one that was brought by Kasneb through its pilot paper that was released recently. A sample of the pilot paper is what we have before us here. So I'll be opening a sample of the pilot paper so that we can see how it looks like and how your questions are going to look like. So this is the pilot paper, a sample that was just released the other day. The pilot paper for business data analytics, which is a practical paper, consists of 2 sections. We have section 1, which has a total of 40 marks, and it is tested through multiple choices, because in this section, students are required to pick the correct choice from the given multiple choices. Now, we also have section 2. Section 2, which is a total of 60 marks, is where now you'll be required to solve much of these questions using Excel. Like there is question 21, which you are required to prepare a spreadsheet showing a forecast statement of profit or loss, of course, for the next 3 years under the scenarios that have been given here. So this is a sample of how you can be able to prepare such a forecast of the statement of profit or loss, of course, using the rates given. Then we had question 22, that is the Rubini Limited, where students were required to prepare a statement of cash flows, of course, for the years ended 30th June 2021 and 30th June 2022, still using Excel. Then there was question 23, where you are required to apply your financial management knowledge to be able to solve this question here, because it has aspects of net present value, discounting rates, and all those other items. Today, we are going to solve the question on statement of cash flows. This is question 22, where it's reading, you are provided with the following extracts of the statement of profit and loss and the statement of financial position for the Rubini Limited for the years ended 30th June 2020, 2021, and 2022. Of course, this is the statement of profit or loss extract for the 3 years. Then we have the statement of financial position as well for the 3 years. Then you have the required, prepare the statement of cash flows for the company for the 2 years ended 30th June 2021 and 30th June 2022. Of course, to be able to do this particular question, especially part A on the statement of cash flows, we will export or convert this PDF file to Excel. So I'll be able to provide or convert this particular file to Excel using the tools that are available. And once converted to Excel, we will be able now to solve it. So here it is. I've pulled the same question. That is the Rubini Limited statement of profit or loss extract for the years ended 30th June, course 2020, 2021, and 2022. This is the exact question that I've pulled from the PDF format. Now it is in the format of Excel. And having gone through it, we have required prepare the statement of cash flows for the 2 years ended 30th June 2021 and 30th June 2022. Of course, all that gives you total of 8 marks. Your knowledge of preparing the statement of cash flows has it that there are 2 methods of preparing the statement of cash flows. We have the indirect method, and we also have the direct method. Remember, the indirect method is where you are required to adjust your profits, of course, your bookkeeping profit, for the effects of those items which are not cash in nature, like depreciation, amortization, and impairment. You also adjust that for the items or transactions which are not operating activity, things like gain or losses from the sale of non-current asset. And we also adjust it for the effect of accruals. So if there is any accrued expense, you're also supposed to adjust for it for you to be able to get cash generated from operating activity. Then we have the direct method of preparing the statement of cash flows. The direct method is used where all the information that will enable you to get the gross cash receipts and gross cash expenditures or payments, of course, those methods of getting such things have been provided. Now, in our question here, we can be able to use both direct method and indirect method, but I'll go straight and use the indirect method of preparing the statement of cash flows. So cash flows are categorized into 3. We have cash flows from operating activities, we have cash flows from investing activities, and finally we have cash flows from financing activities. So we are going to start with the cash flows from in operating activities. Cash flows from operating activities. That is the first heading of cash flows here. From operating activities. I'll, of course, make that bold, and I'll also underline that. I'll bring the currencies, or before the currencies, I can be able to bring the years. They said 2021. I'll also bring the other one, that is 2022 as the year. I'll also bring 2022 that way. Maybe I can center that it is well centered like that. Perhaps this could be here, this way, so that I bring the currencies for those respective years that way. This one can also be made to be bold. Then our cash flows from operating activities. For you to be able to get cash flows from operating activities using the indirect method, then it means that we can use any of the profits here. You can start with the operating profit, that is profit before interest and tax, if you want. You can start with the profit, this is profit before interest and tax. There is profit before tax. There is also net profit. There are 4 profits here that you can be able to use. There is net profit, there is profit before tax, there is profit before interest and tax, and if you so wish, you can even start with operating profit. So depending on the profit that you start with, of course, that is what will really matter when making adjustments here. Like if you start with operating profit, then there will be no need of making adjustments for depreciation, which we see here. If you start with profit before interest and tax, then of course you must adjust for depreciation. And of course, when you start with the net profit that is below here, then it means you also adjust for so many items there. So I'll pick profit before interest and tax. Profit before interest and tax there. I'll not make it bold. So profit before interest and tax, in this particular case, this one for 2021, profit before interest and tax for 2021 is that. Then we also have profit before interest and tax for 2022 is this. So Control V there. So Control V, so that is profit before interest and tax. Once we have profit before interest and tax, of course, we will add back. What can we add back? Profit before interest and tax, we'll add back depreciation. So depreciation was given as 800 and 750. So I'll be adding back depreciation. So add back depreciation. Add back depreciation. Of course, this one is not to be bold. This one is not to be underlined. So depreciation is 800 and 750. So I'll use 800 here, and I'll use 750 there, and 750. So it's supposed to be in bracket. So I'll adjust this. More number formats. I'll go to custom, scroll down, and find the one that is exactly showing that, which is here. I'll click on it, and of course you can see it's in bracket now. So you add back depreciation. You check for any other thing to add back. If at all given in the additional information, there was nothing like that. Of course, for profit before interest and tax, it means finance cost is yet to be deducted. Tax expense is also yet to be deducted. So you won't adjust for those. Then this will give you operating profit. Operating profit before working capital changes. Operating profit before working capital changes. That will be given by this. I think something is wrong somewhere. We are adding back depreciation. So that is 800, and this one is 750. So yeah, 750. So that you get equal sign. So we are adding it back before, because it had been deducted before arriving at profit before interest and tax. So remember, depreciation had been deducted, so you add it back. So this is that plus this. Get that. Then again, equal sign, this plus 750. And it will give you your answer of 27,506. So that is profit, operating profit before working capital changes. Now we want to go to changes in working capital. When we talk about working capital, we are referring to inventory, we are referring to receivables, and we are referring to payables. So we are going to look at those items and see how they changed. Or starting with the inventory, and you check 2020, 2021. So inventory here was 15, here it was 21,750. So that is the increase in inventory. So increase in inventory. When you talk about increase in inventory, that one is an outflow. When inventory increases, it means that you went and purchased inventory. So increase in inventory will be given by what we had here. Subtract this, then you'll get your increase in inventory, of course, which is an outflow. So that is increase in inventory. Here it will be equal sign. Inventory increased from this minus 27,488, and of course the increase in inventory there is 5738. Of course, 5738. So this will be there. It is fine that way. Then there is also receivable. It's also increasing. So we also have increase in receivable, increase in receivables, so equal sign. Now receivables are increasing from this, cost minus this, so that is increase in receivables. On the other side, receivables is increasing from 8750, cost minus 15,460, and that one gives you that increase in receivables. Then we look at payables. Payables, they are also increasing. So increase in payables. Remember, increase in payables are inflows and not outflows. So increase in payables, it means you've received more money, or you went and purchased goods on credit. So that one is treated as an inflow. It will be equal sign. Increase in payables, now we use this minus this one, it's an inflow. The other one will be equal sign here minus this, and that one is increase in payables. So that becomes increase in payables there. After that, we will be getting the cash generated. Cash generated from operations. Cash generated from operations. Cash generated from operations. The spelling of operations looks wrong. That is cash generated from operations. Now on cash generated from operations, it will be the aggregate of what we have here. It's operating profit before working capital changes, plus increase in inventory, plus increase in receivables, plus increase in payables. You'll get your cash generated from operations. The same, equal sign, this plus here, plus here, plus increase in payables. Of course, you get the cash generated from operations. So that is cash generated from operations. Once you have that, of course, we move to finance cost paid and also income tax expense paid. So finance cost paid and income tax expense paid. We check if at all there is any additional information that would affect that to necessitate a control account, but there is none. So finance cost paid, finance cost paid, So finance cost paid here will just be what we have here. Finance cost paid, let's use minus, so the finance cost paid is 7,000 here, 7,000, so you can as well just say equal sign 7,000, equal sign 7,000. The other side equal sign 9,000, so you can see equal sign 9,000, it takes this. So that is finance cost paid. What about income tax paid? Income tax paid. So the income tax paid, the same tune. There is this 43. Then again equal sign 53.27. That gives you 53.27. So that is income tax paid. This will give you the net cash flows from operating activities. Net cash flows from operating activities, which will be the aggregate of cash generated from operations plus finance cost paid plus income tax paid costs, and you get 2840. The other side, this is 16,389. You add 9,000. You add 52. Remember, the ones that are in bracket are outflow, so it will just deduct and give you the answer. So that is 2062. So that is net cash flows from operating activities. Net cash flows from operating activities. After that, we move to cash flows from financing activities, not financing but investing activities. From investing activities, cash flows from investing activities. And on cash flows from investing activities, of course, we'll be seeing the changes in property, plant, and equipment. Remember, this property, plant, and equipment can only be affected by three things. One, acquisition of new property, plant, and equipment. Two, revaluation of property, plant, and equipment. Three, disposal of property, plant, and equipment. That is if the PPE has been stated at cost. But if the PPE has been stated at net book value, then depreciation as well will be affecting property, plant, and equipment. So what we have here, reported as PPE, I believe is at net book value, and it will as well be affected with depreciation. Now, the only change here that we are going to get on investing activity will be, of course, whether it's acquisition of property, plant, and equipment. We are going to see that. If this is the opening balance of property, plant, and equipment for 2020, then this is the closing balance, which has increased so immensely. You can see from 25,800 to 45,200. That can only tell you one thing. The business purchased new items of property, plant, and equipment. Remember, there is no revaluation. Under equity here, there is no revaluation, so there was no revaluation that was carried out. So the only thing that affected property, plant, and equipment must have been acquisition and depreciation. So it's acquisition and depreciation. So what we do for you to be able to get what was purchased is that you take balance at the end. Of course, balance at the end. On it, you will add depreciation that was charged. Depreciation that was charged. Then you deduct the balance at the beginning. That will give you what was purchased during the year as far as property, plant, and equipment is concerned. So that is cash paid to acquire PPE, or you can write it in full, property, plant, and equipment, to acquire property, plant, and equipment. So the solution will be equal sign. You take the balance at the end, that is at the end of 2021, add depreciation that was charged during the year. It's better we choose this same as this, yes, but I want to use this because this is what that will be, the one that will give us adding. If you use this, it will be subtracting, which is wrong because they are in bracket. So we'll be using 800. You add 800, so I've clicked on 800. You less balance of PPE at the beginning of the year, which is 25,800. So you click on 25,800. What remains here there is what was paid to acquire. That is the balance on the debit side of PPE account, which gives you 20,200. The same case as this, equal sign. The balance at the end of the year 2022 is 46,700, so you click on 46,700. Add, depreciation charge for the year was 750, then you less balance at the beginning of the year, which was 45,200, so we have 45,200 here. Then you enter. That gives you 2,250 as cash paid to acquire property, plant, and equipment. But they're supposed to be outflows, of course. They're supposed to be outflows, so we'll find a way of making them outflows. Let's see. If we go to custom, click on OK, it's still not bringing. So we will find a way of having that. The answer was, let me move back. You can see the answer is 2,200 and 2,250. So 2,200 and 2,250. 2,200 and 2,250. 2,200 and 2,250. So this is 2,250 because it's an outflow. This one should be 2,200. It was 2,200, I believe. 2,200. Let me confirm. Must have been 2,200. Yeah, 2,200. So this one is also 2,200. So it needs to be in bracket because it's an outflow. 2,200 and 2,250. So I believe you've seen how we got 2,200 and 2,250. Now there is no any other investing activity apart from that. There are no other non-current asset that we can use. So we'll be getting net cash flows from investing activities, net cash flows from investing activities. Of course, the same answer that we have here. The same answer that we have here, net cash flows from operating activities. I want this bold because it's such a major heading. Then finally, cash flows from financing activities, cash flows from financing activities, cash flows from financing activities. Now on cash flows from financing activities, you will be looking at the long-term borrowings and you'll be looking at the equity, how the equity changed, Now on long-term borrowing, you can see it's increasing. Long-term borrowing here is increasing. When it's increasing, it means it's an inflow. You borrowed more funds, so it's an inflow. So equal sign, that is increase in long-term borrowing, and it will be equal sign this minus the other one, because of course it's an inflow. The other one is also increase in long-term borrowing, 60,000 minus 46. That is also an increase in long-term borrowing. Then we go and check what happened in equity. Paid up capital remained the same, so it means that there was no change. Look at what happened in retained earnings. So you want to assess and check whether there was dividend paid or not. Now look at this. There is retained earnings balance brought down of 70/80. Balance brought down of 70/80. Now on this balance brought down of 70/80, the balance carried down was 30/53. So we want to see how. Of course, 70/80, let's just see this one, 70/80. If you add profit for the year, remember there is profit for the year 2021 here. So So you click on that, it gives you 3053, which is the 3053 that is here. So it means there was no dividend that was paid. So there will be no dividend. Let us also test the last one. Equal sign. They started with a profit of 30. They ended with a profit of 15,482. We want to see how. So balance brought down of 30, 53. Add profit for the year of 12. There's a profit for the year of 12,429. Let's see if we'll get the 15 here. If you enter, the answer is 15,482. So that is fine. Again, there was no dividend that was paid. So it means this will be the only cash flows from financing activities. So that will be net cash flows from financing activities, net cash flows from financing activities, net cash flows from financing activities. Of course, it is the same answer that we have there, the same answer that we have here. The last part is to aggregate all the cash flows and get cash and cash equivalents. Cash and cash equivalents. That way. So cash and cash equivalents for the year is an aggregate of cash flows from operating activities, add cash flows from investing activities, add cash flows from financing activities. So equal sign 2840 plus 2200 plus 13334. So that is 4026. The other one, equal sign, this plus that plus this. We will get 13145. Cash and cash equivalents brought down. Then we have cash and cash equivalents carried down. So cash and cash equivalents brought down, because that has been given, equal sign. The cash that you started with in 2021 was the cash that ended in 2020. So cash and cash equivalent here is 0. Add bank overdraft that was here, 5297. Of course, you get 5297, but it should be an overdraft. So equal sign 0 minus this. So it's an overdraft. The other one, equal sign 0 minus 9322. It's an overdraft of that one. Now cash and cash equivalents, when the period was ending, of course this will be equal sign this plus that. 9323. 9323 is the answer. Here you can see that cash at the end of the year, that is 2021. If you move down with the 2021, 0. Then this one is an overdraft of 9322. 9322. So this and this should be the same. They should be the same. 9322. This one is 9323. So they are not. Equal sign. Let us test the other one. This plus this. That is 3823. 3823. 3823. Let us confirm. It is an inflow. There is money. There is cash at the end of the year. 3823. Look at cash. The overdraft is 0. The other amount is 3823. So this is correct. 3823. 3823. You can see 3823. 3823. The other one is an overdraft of 93.22. Overdraft of 93.22. Here we got 93.23. So there's a difference of 1 for the cash flow that we've prepared for the year ended 30th June 2021. So this is how you are supposed to deal with this question on preparation of the statement of cash flows, of course using Excel. The same thing that you know, but can you do it using Excel? That is the big question. Can you do the same thing using Excel? And if you can, then it means that you can be able to prepare a statement of cash flows. In our subsequent classes, we are going to look at other questions that were in that pilot paper, more specifically the question 21 on section 2, which required us to prepare a spreadsheet showing the forecast statement of profit or loss for the year, for the next 3 years under, of course, each of the 3 scenarios. But that will come later. For now, I would like you to comprehend this and see if you are able to repeat whatever happened here. Bye for now and see you in our next session.
Hi there, my student. Welcome to Manifested Online classes. My name is Joseph Kemani. So in this session, I want us to look on illustration question on preparation or presentation of a statement of cash flows. And I want us to go through that particular question, and then we see what was required. So the question reads, Lilongwe Limited is a public listed company. Details of the company's statement of financial position as at 31st of March 2022 and 31st of March 2023 are shown below, together with other relevant information. So we have the statement of financial position as at 31st of March 2023 and 31st of March 2022. So we have non-current assets, which include property, plant and equipment, intangible assets, and then other current asset we have inventory, trade receivables, interest receivable, short-term deposits, and then we have bank. Other share capital and reserves we have ordinary share capital, and then reserves include share premium, revaluation reserve, and then we have retained earnings. Then we have the total equity. We have non-current liabilities, which include 12% loan notes, 8% variable rates loan notes, and then we have deferred tax. Other current liabilities we have trade payables, bank overdraft, and then we have what? Taxation. And then we have some additional information, number 1, 2, 3, 4, 5. And then what are we required in our question here? We are required to prepare a statement of cash flows for Lilongwe Limited for the year which ended 31st of March 2023 in line with International Accounting Standard number 7, which governs the presentation of the statement of what? Cash flow. Now, first of all, if you check on this particular question here, the examiner had not specified which method you should use in preparing that particular statement of what? Cash flows. But generally, anytime you come across a question for cash flows and you are given the income statement, you are given the statement of financial position, always use the indirect what? Method unless otherwise what? Required on unless otherwise what? Stated. So therefore, in this case, we are going to prepare now our statement of cash flows using what? Using the indirect method. But before we do that, I want us to go through the additional information, and basically we see whether there are some workings which are required as far as that particular question is concerned. So let's go through the additional information. We see what you are told. Number 1, you are told details of property, plant and equipment as at 31st of March 2023. Basically, that is the end of the current financial year, and therefore those are the closing balances. And then 31st of March 2022. 31st March of 2022 is basically the end of the previous year, in which case those balances at the end of the previous year will be the opening balances in the current what? Year. So we are given 3 items for each year: the cost stroke valuation, the depreciation, the carrying amount, and then we are given that for added buildings and plant and what? And plant. So basically what that means is that the property, plant and equipment, which is in our statement of financial position, comprised of two assets, landed buildings, plant, and then we are given their what? Their costs, the accumulated depreciation, their net book value, both at the start and also at the end. So no working which is required at this point, but we may be required to come back to that note. Let's move to note number 2. We are told the company revalued the carrying value of land and buildings by an increase of 70 million on 1st of April 2022. So 1st April 2022 is automatically the start of the current year, because the current year ended 31st of March 2023. That year started on 1st of what? April. And therefore, you're told land and buildings were revalued upward, and there was a revaluation gain of what? 70 million. And then you're told in the other sentence, on 31st of March 2023, that is now at the end of the year, the company transferred shillings 3 million from revaluation reserve to the retained earnings relating to depreciation on revaluation of buildings. Equally, no working which is required as far as that point is concerned. In note number 3, we are told during the year the company acquired a new plant at a cost of shilling 60 million and sold some old plant for shillings 15 million, incurring a loss of 12 million. So in that point, we are given two transactions. One, there was a new plant which was acquired, and you have now to remember any activity relating to acquisition and disposal of asset, this is an investing activity. So therefore, in preparing our statement of cash flow, this plant which was acquired will be one of the item you're going to take into account in computing the cash flow from investing activities. Also in the same note, we are told there were some old plant which were disposed. Remember, what you have said is that once the company sells an item of PP, you have to prepare what? The disposal account. And in this case, as per the information which is given there, we are given the sales proceeds, because you are told that old plant was sold for 15 million. That is the sales proceeds. And also now we have what? We have the loss on disposal, which is how much? 12 million. Anytime you see the examiner having given you the gain or the loss on disposal, then there is an item which the examiner may not have given you. So therefore, I think we can start by preparing that particular account there, which is the disposal account. Disposal account. Disposal account. So remember, I've said that in preparing this account, on this side we record the cost of the asset which was disposed. On the credit side we record the accumulated depreciation and the sales what? The sales proceeds. And then the balancing figure in this account we have said will be a gain or a loss. But in that point we are told that this item was disposed at a loss. So we already given the loss, and the loss in our case is how much? Is 12 million. So and all our figures are in million of shillings. So for us to be consistent, we are going to work with all our figures in million of shillings. And then which other item are we given here? We are given the sales proceeds. We are told it was disposed at an amount of what? 15. So if you check on the information which is given there, we are not given the accumulated depreciation. Equally, we are not given what? The cost of that particular what? Item. So, but we will see how to determine those particular what? Values there. Okay, before we go to note number 4 there, and also note 5, 6, there are a number of accounts maybe we can prepare here relating now to the PP. Relating to what? To the PP. For example, from the information we have in note number 1, we can open a number of accounts there. We can open the account for added buildings. We can open the account for plant, because there are a number of items which we must compute here and which are not given. So let's start with the account for what? The account for plant. Plant account. Plant what? Account. And for this particular account, we are going to prepare it at cost. So if we prepare that account at cost, we have now to prepare a separate account for something called the accumulated depreciation. Accumulated depreciation on what? On plant account. We also prepare that particular account here, this account, and also we prepare the other account that is for land and what? Buildings. Land and buildings account. As you are going to see, the number of items we are going to determine by preparing these accounts. So the first thing we need to record here, remember I've said this account will be prepared at cost. Prepared at what? Cost. So what we need to do is to record the cost of the plant at the start of the other is in note number 1. So what is the cost of the plant at the start? The cost stroke valuation. Remember I've said what you're given as the balances on 31st of March 2022. These are opening balances. 31st March 2023, these are the closing what? Balances. So the cost stroke valuation of a plant at the start of the year is 445. What about at the end of the year? The end of the year is 440. Is 4 what? 40. That is balance carried down. Which is 440. Then we record the accumulated depreciation both at the start and at the end. Now the accumulated depreciation, this account do have a credit balance because this is a provision account. So what is the accumulated depreciation on plant at the start of the year? It was 105. And the accumulated depreciation for plant at the end of the year, which will be on this side, is an amount of what? 148. So then we also do the same for building. What was the cost stroke valuation of buildings at the start? It was 500. And then at the end of the year, it was how much? It was 600. Yes, so that's basically what we have in note number 1. And then can we go to note number 2? In note number 2, we are told that the company revalued the carrying amount of landed buildings by an increase of 70 million on 1st of April. So basically what that means is that these particular landed buildings, they were revalued at the start. It is important to note that once the assets have been revalued at the start of the year, then the depreciation for the current year will be computed based on the revalued amount. And therefore what we do is that we ignore the previous accumulated depreciations. For example, in note number 1, I hope you can see the depreciation which are given there for landed buildings for the current year. That is 31st of March 2023. Now that amount of 12 depreciation for added buildings, that is the depreciation for the current year, because I've said that depreciation was computed based on the revalued amount. Once the assets have been revalued, the depreciation for current year we computed based on the revalued amount, and the previous accumulated depreciation are ignored. That's why we are not preparing the accumulated depreciation account on land and what? A building, simply because I've said that the depreciation for the current year for land and buildings was computed based on the revalued amount. In fact, I've said that amount which we have there for the current year, the depreciation on added buildings for the current year, the amount of 12 million is the depreciation for the current year. So what we need to do then, can we go to note number 2? Note number 2, we are told land and buildings were revalued upward with an amount of 70. Generally, remember what you have said is that in preparing any asset account, the number of items you should record here, like in this case, you have said any revaluation gain recorded on this side, and any disposal of asset, and take into account this account we are preparing it at cost. We are going to have now the asset which were disposed at cost. At what? Cost. And take into account also this account is at cost. Depreciation is not recorded here, but it should be on this account here. So the depreciation for the current financial year for plant should be the balancing figure there. I don't think we have that figure. That is one of the items definitely we need to compute. Then on this account we should have any revaluation gain, and basically we know that during the current year landed buildings were revalued upward with an amount of how much? 70. And then what we should have on this side is any disposal. Any what? Disposal. Were there some items of landed buildings which were disposed? Are we given such? I don't think so. I don't think we have such disposal. I don't think we have any disposal on land and what? Land and buildings. So, but we have a revaluation gain of what? Of 70 Yes, so that's what we have in note number 2. But also in note number 3, we have this new plant which was acquired. So a new plant which is acquired, remember for plant and equipment, okay, for plant there was no any revaluation gain, but you are given the acquisition. The acquisition is an amount of how much? The new plant acquired had a cost of how much? Had a cost of 60. I think that's what you're given in note number 2. So as far as that plant which was disposed is concerned, you can see we are only given the sales proceeds and also what? The loss on disposal. The loss on what? The loss on disposal. The loss on disposal. Yes, so that I think what we have. So what we need to do now, I think we can start by balancing these two accounts here. These two accounts. So of which you can see what we don't have here is now this disposal. And basically this disposal is what we are going to record here. This is a cost of this item which was disposed and which are not given there. So therefore, can we do that? What we have on the debit side is 445 plus 60. That will give us 505 minus what we have on the credit side, that is 440. So that will give us 65. So basically it means that this item of plant which was disposed, it had a cost of 65. It had a cost of what? 65. And automatically, then we can get the balancing figure here, which represent the accumulated depreciation of that item which was disposed. So we take 65 minus what we have on the credit side, 15 and 12. So that will give us 38. So this is the accumulated depreciation of the plant which was disposed. Now this particular accumulated depreciation, the figure of 38, then we should bring it to this account because this is part of this opening balance and that plant was disposed. So we have the accumulated depreciation for the item of plant which was disposed. How much is that? Is 38. Then we balance this account. The balancing figure here represent the depreciation for the current financial year and which was taken to the income statement. What we have on the debit side is 148 plus 38 minus what we have on the credit 105. So which will give us 81. So this 81 now represent the depreciation for the current year. Represent the depreciation for the current what? Yes. We also need to balance this account and basically the balancing figure in this account will be the acquisitions. Because in our case here, we don't have any disposal. Anytime there are some items of PP which were disposed, you must be given that particular information. So in our case, we don't have any disposal. And then because you are preparing this particular account also at cost, we don't have to credit the depreciation on this side. But there is a figure which I think I recorded the wrong figure here. So this is the closing balance. So I need to record the opening balance, which was how much? Which was 420. Which was 420. Yes, 420. And then from there, what we need to do is basically we balance that account. So let's balance that account. We see what will be the balancing figure. What we have on the credit side is 600 minus what we have on this other side, 420 and 70. So we are going to have a balancing figure here of 110. So this 110 represent now the items of or basically represent landed buildings which were acquired during the current year. So I think we are through with that additional information number 1, number 2, and also number 3. So let's move to note number 4. Note number 4, we are given the statement of profit or loss. I don't think we have any working which is required as far as that is concerned. There was an operating loss, interest receivable, finance cost, loss before tax, income tax, repayment claim, and then we have the deferred tax charge, and then we are told we are given the loss for the period, and then you are told the finance cost. The finance cost is which we have in the income statement up there, the figure of 24. It included the interest expense and also the penalty on early redemption. So this penalty on early redemption is basically a penalty which was which the company paid to the bondholders for redeeming the loan notes early. So basically these are not an operating expense, and therefore when computing now the cash flow from operating activities, we are going to add it back to our profit or basically to our loss because it's not an operating expense. And then number 5, we are told the short-term deposits are deemed to be cash equivalents. And then number 5, we are told the dividend paid by the company amounted to what? 25 million. So I think no workings which are required, and I think now with that we can go straight to what is required. We prepare our statement of what? Cash flow. So we need to have the title here. The name of the company is Rilongwe Limited, and this is a statement of cash flows, statement of cash flows, which is for the year, which ended